Hi friends, so finally I'm going to upload something called as concept videos for your CA inter cost accounting as well as financial management. So cost and management accounting, I've released a concept book, as well as financial management, I've released a concept book. Using this concept book, I am going to upload something called as concept revision videos. These are going to be extremely useful at the revision phase for you guys. Only 2-3 special points which I want to tell you. These are for revision purpose. So you can use this only to revise concept, which means you have to be aware of the concept first. If you are not aware of the concept and then use these videos, it may not give you the required result. So please do prepare first at your end, be it the cost and management accounting concept, which is there for all the 15 chapters, or your FM concept, which is there for all the 9 chapters, the practical chapters. The theory chapters are obviously not covered. For theory, I've separately uploaded theory videos which are added in the description of the video. In the description, you will find the theory videos link. Now, what disclaimer I want to give is, when you watch these videos, first you prepare at your end, then watch it. Second, in costing, we are discussing around 300 plus MCQ. These MCQ are concept based MCQ. They will help you in answering your exam MCQ as well as answering the detailed question. Only thing is, I've discussed as a part of my class when I taught that concept, and immediately I did this revision. So students were fully aware of the concept. At your end, you may not be aware of the concept fully. So you can take time to read it, and whenever I discuss an MCQ, please pause the video when an MCQ is discussed. You answer it, then unpause the video, and then look at the answer which is discussed. Don't go with the explanation I give before you solve it. So you will have to keep pausing your video multiple times. Pause, solve, unpause, look at the explanation, again pause, because multiple MCQs are discussed. In costing, around 300 plus MCQ. In FM, around 200 plus MCQ are discussed. Entire subject of costing is around 10 hours. FM could be around 5 to 6 hours. Entire subject will get revised. You will not missing out on any concept. If you are clear on this, you can handle any type of problem in costing as well as FM. So what you should do is, after this is done, you pick few questions from my question bank. I'll share the link for that also. You pick few questions and solve it, and that is sufficient to score 60 plus in my paper and costing, and FM obviously 30 plus, and balance you manage through your SM. This is what I want to say. Now the concept video will start. You can keep going through it chapter wise. The timestamp are attached in the video. You can go through whichever chapter you want. You need not follow the order in which I'm uploading. Any order you can follow as per your preference. Thank you friends. The concept video will start now. I'll first revise time value of money, which was a very simple discussion we had. What we learned in time value of money is the value of the money keeps changing with time. Rupees 100 today is obviously worth more than getting 100 a year later because of inflation. Inflation is going to eat away the power of money or value of money, and that is why it's very critical that whenever somebody says I am earning so much, along with that, when is the most important factor? Timing is very, very critical. We learned certain concept. One is called future value. What is future values? Tomorrow's value of today's money. We have present value, we have future value. You can go here by doing compounding and come back by doing discounting. Future value to present value is called discounting, and present value to future value is called compounding. Either I do compounding approach or I do discounting approach. So future value is tomorrow's value of today's money compounded at time value of money. We had a formula: future value is equal to present value into 1 plus r the whole power n, or technically it's called future value factor. A simple example: I am depositing 55,650 in a bank. This is called present value, today's investment. it will give me 15% rate of interest, which is called R, on a 10-year deposit. On a 10-year deposit is power 10. On a 10-year deposit, this 1 plus 15% power 10 can be given in question as future value factor 15% comma 10. Future value factor 15% comma 10, and the question can directly give you this number. This is called future value. Present value is reverse order. Present values today's value of tomorrow's money. Today's value of tomorrow's money discounted at time value of money. Discounted at time value of money, where the formula is present value is equal to future value divided by 1 plus r the whole power n. This 1 divided by 1 plus r the whole power n is technically called present value factor. That's technically called as present value factor. In short, if you want present value, multiply with present value factor, which is what we have been doing in capital budgeting, year cash flow, PVF, DCF. And if you want future value, multiply with future value factor, which is what I did in modified IRR. In the modified IRR question, I multiplied with 1 plus r the whole power n, and in our normal question we have been dividing by 1 plus r the whole power n, writing the factor, and again doing a multiplication, So an example here, 2,50,000 is the amount which I have. This is the amount which I'll get in future. So future value is 2,50,000. When you turn 30, the gap is 11 years. Rate of interest is 9%. So 2,50,000 divided by 1 plus 9% comma 11. I'm not getting much into the calculation part because these are basic simple concepts which we have already covered. Just to quickly go through them. Uneven cash flow. What is uneven cash flow? Is there is a cash flow which is happening in the first year, second year, third year, fourth year. If it's the same amount, it's called annuity. If it's a different amount, then either you can discount it and bring it to today by using the respective PVF, by using the respective year PVF, or you can use future value factor and take it to the future period. Either use the present value factor or future value. Last question what we did is future value factor. That modified IRR question, we did technically future value factor and took it to the future period. I can also take it to the prior period by doing something called as the present value factor. By doing the present value factor. Annuity is nothing but equal receipt or payment for a specified period. The period could be per week, per month, per year, per half year, per quarter. It could be anything. If it happens at the end, that is called annuity regular. But if it happens at the beginning, that's called annuity immediate. Formula for future value of annuity regular and present value of annuity regular is annuity amount into future value annuity factor or present value annuity factor. How you calculate present value annuity factor is 1 divided by 1 plus the rate of interest equal to you keep doing GT or equal to plus M plus equal to and M plus. This is on present value. If you want future value, you start with 1, put M plus into 1 plus R equal to M plus into, you'll have to keep doing the cycle and check the number of times you press M plus and then put MRC. If you have to do annuity immediate, then just do into 1 plus R on this answer in both the formula. Just do into 1 plus R for both the formula. Perpetuity means there is no end to this. Perpetuity effectively means there is no end. Because there is no end, I cannot calculate a future value. I cannot calculate a future value when there is no end to a perpetuity. I can only do what? Present value. So for perpetuity calculation, very simple logic is present value of perpetuity is equal to whatever is the perpetuity amount divided by rate of interest minus the growth rate. That's a single formula. If growth is not there, write minus 0 in the denominator. Write minus 0 in the denominator. And my compounding frequency can change my effective rate of interest which I earn on a deposit or which I pay on a loan. 10% FD may turn out to be better than 10.5% depending on the compounding frequency. If you are going to pay interest every month and 10.5 once a year, 10 may turn out to be better. May turn out to be better. We'll have to do that calculation. That's called effective rate of interest. 1 plus R the whole power n minus 1. N is number of compounding periods in a year and R is the rate of interest per month, per quarter, depending on the frequency. Depending on the frequency. This is the base we set for our next chapter, which was on investment decision. Let's go through every concept. First is, we learned what is investment decision. Investment decision or capital budgeting is basically budgeting for capital expenditure. Why should I worry about this? Because it involves a huge expense. When you do a sizable expense, and if you go wrong, your entire business can get wound up. Your business can get wound up in case you take a wrong decision. That is why I want to be doubly, triply sure before taking up a capital expenditure. If I'm buying a mobile phone or a laptop or a car, I'll not randomly go and buy. I also buy on a daily basis. I buy a lot of items which could be worth 10 rupees, 20 rupees, 50 rupees. I'm not bothered about them. But if I'm buying a sizable amount, I don't want to go wrong in that. That is what capital budgeting is all about. Budgeting for capital expenditure. Capital expenditure is something which involves a huge outflow today, in anticipation of what? Future inflow. You are anticipating future inflow, and because of that you are doing a huge expenditure. But this expenditure is happening today, inflow will come later. Because of the uncertain element, because of the uncertainty, you don't want to go wrong in this. That is why you want to do a proper evaluation. We learn multiple techniques of evaluation. The first technique of evaluation is payback method. What is payback saying is number of years taken to recover my investment. Payback the money which I gave you, number of years taken to recover the investment without considering time value of money. How we do calculation? Year cash flow, cumulative cash flow. Year cash flow and cumulative cash flow. That's an add-on we add. Year cash flow and cumulative cash flow. I'll have to check the CCF. When does it become negative for the last time? If CCF becomes negative, it means from negative it turns out to be positive. You means you have achieved the payback. So the formula is base year. Base year refers to the last year in which CCF is negative. Unrecovered cash flow of base year, how much negative in that year, divided by cash flow of next year. Rule is very simple. Accept it if it is lower than your target payback. You have a target payback, 4 years payback you want. Anything less than 4 years, accept the project. And choice means between two projects, select a project which has lower payback period. Both have to be first acceptable. Payback reciprocal is opposite of payback method. Technically the formula is 1 by payback. Or I can say how much average inflow. See, what is payback? I do an investment of 2 lakh rupees. Every year I get 50,000. 2 lakh divided by 50,000 is the payback. 2 lakh divided by 50,000 is payback, which is 4 years. Opposite of that is 50,000 divided by 2 lakh, which is 25%, or technically 1 by 4 years. Technically 1 by payback reciprocal is inverse of the payback period. In this example, I do 10 lakh investment. First year, negative 10 will become negative 5.5 because you're recovering how much? 4 lakh 50. Then it will become negative because you're recovering 5 lakh. Then it will become positive 2 lakh, which means second year is my base year. How much negative in the second year? 50,000. How much is the cash flow of the next year? That is my payback period. Clear? Any doubts on this? Very simple calculation. Now, Rakesh Limited is considering investing in one of the 4 projects for which I have calculated payback reciprocal. What is payback reciprocal? Is inverse of payback. Payback reciprocal is inverse of payback. So, payback of project P, 1 divided by 25%. Do in the calculator. 1 divided by 25%. 1 divided by 40%. 50%. 75%. I'll select whichever has lower payback. Payback reciprocal is nothing but inverse of the payback period. So if you do 1 by payback period, you'll get payback reciprocal. 1 by payback reciprocal, you'll get the payback period. So end up selecting project end up selecting project. Last project was which one? Yeah, project S. Project S as the lowest payback. A project requires an initial investment of 20,000, will give an inflow of how much? 4,000. What is the payback reciprocal? What is the payback reciprocal? Can you tell me what is the payback period here first? What will be the payback period here? 5 years. 20,000 divided by 4,000. 20,000 divided by 4,000. I would want participation, guys. 20,000 divided by 4,000. Inverse of 1 by 5. Inverse, that is 1 by 5 is how much? Into 100. Which is the payback reciprocal. Which is the payback reciprocal. There's a formula for that. But logic is this. It's the inverse of the payback period. Discounted payback is same as normal payback. Only things you'll have to add what? Time value of money. So year, cash flow, PVF, DCF, CDCF. PVF, DCF and CDCF. You'll have to bring cumulative discounted cash flow in the calculation. Same formula. Base year refers to the last year in which cumulative discounted cash flow is negative, plus how much? Negative 177, 950. How much is the discounted cash flow of the next year? How much is the discounted cash flow of the next year? Base year plus unrecovered discounted cash flow of base year divided by discounted cash flow of next year. NPV is PV of inflow minus PV of outflow. Select a project if you have positive NPV. Between two projects, select whichever has higher positive NPV. Quickly give me answer to this. Calculate. Do in your notebook if you want. Year, cash flow, PVF, DCF, whatever way you want to do it. Get me the answer to this. Get the answer to NPV quickly. What is the annuity factor? 3.79. Okay, multiply 3.79. Sorry, 56,000. 86, 68, 65. Any doubts in this? Any doubts in this? It's a fairly simple concept. We have been doing NPV multiple questions. We have done PV of inflow minus PV of outflow. This variant of NPV is called profitability index, benefit cost ratio, present value index, or desirability factor. What is the concept? Is benefit cost ratio is ratio of benefits to the ratio of cost. Ratio of benefits to the ratio of cost. Benefits is my inflow, cost is my outflow. So PV of inflow divided by PV of outflow. It can be expressed in times or in percentage. I will select if you are generating more than one. If you are generating more than one time, I'll go ahead and select that project, and between two projects select one which has higher PI. Now NPV is 2 lakh. Initial outflow is how much? 10 lakh. If outflow is 10 lakh, NPV is 2 lakh, inflow is how much? Inflow is 12 lakh. Inflow is 12 lakh. How inflow will be lesser than the outflow? Inflow is 12 lakh. So in profitability index is inflow divided by the outflow. Inflow divided by the outflow. This is what we did in that capital rationing example. This is what we did when we were doing capital rationing. 12 lakh divided by 10 lakh, you get what? 1.20 times. Clear? Any doubts on this? Okay, give me properly answer for this.
I heard 6 lakh, I've heard 4 lakh. There are four options only. You can tell all the four. One of them will be right only. 1 lakh, outflow is 5 lakh, profitability index is 1.25, which means inflow is 6 lakh 25, and NPV is 625 minus 5 lakh. NPV is 625 minus 5 lakh. See, you know all the concept, and MCQs will come like this. You'll unnecessarily make mistakes on this. These are concept which are known to you. If you make mistakes here, I cannot really help it. So what is the answer? 1 lakh 25. Next is accounting rate of return. Only technique which is based on what? Profits. This is the only technique which is based on profits. It is the ratio of average profit after tax on a denominator of initial investment or average investment. Initial investment means take the opening investment. Average means opening plus closing by 2. Closing is equal to salvage value. Closing is equal to salvage value, which can be 0 in many question, which can be 0. Concept is also here. If your ARR is more than target ARR, select the project, otherwise reject it, and between two projects, select one which has better ARR. Initial investment 5 lakh. My salvage value is 1 lakh. What is the average investment if I consider these two? 3 lakh is my average investment. Average PAT is how much? 1 lakh. So 1 lakh divided by 3 lakh. What is the ARR on average investment? And this will also help me in doing IRR calculation. When I do IRR, I'll take 2/3 of this. I'll take 2/3 of this as the initial guess rate. 2/3 of this as the ARR on average investment. Consolidated format for doing all the 5 techniques. Year, cash flow, cumulative cash flow takes care till payback. PVF, DCF, CDCF take care of your discounted payback. NPV, profitability index. Depreciation and PAT is going to take care of your ARR. And when I do this, year 0 not applicable, because in a single day I cannot have any depreciation or profit after tax. Then comes the last technique, which is internal rate of return. It is the rate of return which is being earned by the project. Ultimately, this is also the discount rate at which NPV of the project is 0. Discount rate at which NPV of the project is 0. Just because I'm generating 0 NPV does not mean I'm not earning anything. I'm earning the rate of return, which is the discount rate. Ideally, I should earn more because I wanted 12%. If I earn 12% only, company doesn't save anything, because this 12% will go to my providers of capital. Money comes from few people, money comes from debt guys, money comes from equity guys. I have to give them money. So I'll give it back to them. But I want to retain something in the company. That is possible only if you earn more. If you earn more. So if you do calculation and you get positive NPV, it means IRR is greater than the discount rate or cost of capital. If you generate positive NPV, IRR is greater than the discount rate. If you get 0, IRR is equal to discount rate. And in case it's negative, IRR is less than discount rate. Now, in order to calculate IRR, I need two discounting rates. What is the easiest way of doing it? Question below the table gives it some percentages. I work with that. Otherwise, I'll have to calculate ARR on average investment, where year cash flow will be there. Add up all the cash flow. That will give you total profit of the project. Divide by number of years. That will give you average profit. Divide by average investment into 100. Do into 2 by 3. One positive, one negative. Either do interpolation or do timeline approach. Interpolation is lower rate plus NPV at the lower rate divided by NPV at lower minus NPV at higher. When you do this, minus of minus will become plus in the denominator, into L2 minus L1, In case you have only one outflow and one inflow, I can use this formula. This is possible only if it's 2, 4, 8, 16. When I did modified IRR, it was 5 years. 5 years, I said I cannot use this in the, I can do it in Excel. 5 years, Excel can handle it, but calculator will not be able to give me the answer for power 1 by 5. You will need power 1 by 5, which is not possible for you to do. So technically, if I have only one outflow, one inflow, I can do shortcut. And if it's a perpetuity, I'll use the formula of perpetuity, which is present value of perpetuity is equal to perpetuity amount, which is my inflow every year. Present value is my outflow divided by rate of interest minus the growth rate. Clear? Any doubts on this? Do this and give me the IRR answer. Do this and give me the IRR answer. Lower rate, plus what is the numerator? NPV at the lower rate divided by NPV at lower rate minus of minus NPV at higher rate into L2 minus L1 into L2 minus L1. Ultimately, answer is only 10.86 possible because that is the number which is between 10 and 11. The final answer has to be between 10 and 11. One positive NPV and one negative NPV. Next, annual cost saving is 40,000. Annual cost saving is 40,000, which means every year I generate 40,000. IRR is how much? 15%. Profitability index is 1.064. What is the NPV of the project? What is the NPV of the project? Now, in this situation, at IRR, what will be the NPV of the project? 0. So, year, cash flow, PVF, DCF, year 0, I don't know my outflow, 1 to 4, 40,000. Can you tell me at 15% what is the annuity factor? At 15%, what is the annuity factor? 2 point, multiply this. Negative 114, 200, and this is 1. My investment is 114, 200. My investment is 114, 200. Then I'll use the formula of PI. What does PI say? PV of inflow divided by PV of outflow. I know my outflow. I'll get inflow as balancing figure and then calculate my NPV. Then calculate. In other words, NPV is 0.064. 0.1 time is my investment. Extra is my NPV. Do 0.064 into 114, 200. 0.064 into 114, 200. 7309. Clear? Any doubts on this? Because what is NPV is the extra generation. NPV is nothing but the extra generation. Extra generation is easily calculated as more than that one. Any doubts on this? Give me the answer to the next example. Perpetuity calculation, do it. Do the perpetuity calculation. I've just explained it. Sorry. The formula is what? Present value of perpetuity is equal to perpetuity amount rate of interest minus growth rate. Rate of interest minus growth rate. Present value of perpetuity is today's investment. What is today's investment? 50,000. How much you generate every year? Denominator is rate of interest. Denominator is rate of interest. 8750 divided by 50,000 into 100 to express in percentage. What's the answer you get? 17.5. Can you get me answer to this, please? You should be in a position to handle this. Try in your notebook. Try. I'll discuss anyway. What formula will help me here? Sorry? No ARR needed. What should I write here to calculate this answer? Future value is equal to present value into 1 plus r power 8. 1 plus r power 8. I had told if you have 2 years, 4 years, 8 years, you can try to do the shortcut. Future value I'll get is 21,436. Present value is 10,000 into 1 plus r power 8. 2.1436 is equal to 1 plus r power 8. 1 square root will make it 1 plus r power 4, not power 6, will make it power 4. Another square root will make it 1 plus r square. Another square root will make it 1 plus r. Another square root will make it 1 plus r. Take 3 times square root. 10, exactly 10%. Any doubts on this? Any doubts on this? All the examples are on IRR discussed. If you are able to go through the concept book properly, you should be in a position to revise most of the concepts. Any doubts on this? Next is capital budgeting projects. Whenever I do a capital budgeting project, the project can give me two things. Guys, please. The project can give me two things. Either there is a revenue enhancement or there is a cost reduction. Revenue enhancement means I earn more revenue. Cost reduction means we are bringing down cost. From an analysis point of view, both are inflow in step 2. Both are inflow in step 2. An investment can either lead to revenue enhancement, increase in revenue, or cost reduction. Both will ultimately improve the profits or cash flows of the company. Revenue increase or cost reduction will have the same treatment, while computing cash flow. When I do my cash flow calculation, I'll exactly give the same treatment for this item. Clear? Go through this example and tell me what is the cash flow. Let me know the answer. What is the increase in revenues? I can say 5 lakh or I can say 20 lakh, whatever way I want to call it, that doesn't really matter. 20 lakh. Then increase in expenses 15 lakh, so net 5 lakh, and I save 2 into 1 lakh. I save 2 into 1 lakh. So my net cash flow is 7 lakh. When I do my in between flow, first item increase in revenue 20 lakh, decrease in cost 2 lakh, less expenses 15 lakh, net 7 lakh is the amount. Net 7 lakh is the amount. Any doubts on this? Steps in computation of cash flow. My step 1 is initial outflow. I have two items, capital expenditure and working capital. Capital expenditure is for purchasing land and building, plant and machinery. Working capital is to buy raw material and all. So that is my initial investment. In between flow, I can either have increase in revenue or I can have decrease in cost. Deduct all cost, other guy participate, deduct all cost other than depreciation. Then deduct depreciation also. You will get what? Profit before tax, deduct tax, profit after tax, add back depreciation, CFAT. After that, less increase in working capital, add decrease in working capital. Increase in working capital is subtracted, decrease in working capital is added back, less other two, payment for original machine, less purchase of additional machine, Step 3 is terminal flow, where I have net salvage value and I have recapture of working capital. When I do net salvage value, if question says ignore tax on capital gain, block of assets method, no need to do that. Otherwise, net salvage value, sale value, less what? Book value, gain or loss, tax paid or tax saved, leave a line, net salvage value, because there can be something, it's not a continuation of the format. And sale value 0 does not mean NSV is 0. Sale value 0 does not mean NSV is 0. I consolidate and calculate NPV. I'll consolidate this and compute my NPV. If something is critical, I'll discuss. Otherwise, rules for computation of cash flow. We have certain important rules in computing cash flow. First rule is depreciation. Depreciation is a non-cash item, technically no use, but still I'll subtract, add it back to calculate right amount of income tax. To calculate correct amount of income tax, I'll subtract and add it back. Opportunity cost is the cost of the benefit foregone. Example, I am in a hospital, I'm buying a diagnostic machine. Earlier I was giving it outside, earning some commission income. If the commission income is given before tax, deduct before PBT. If the commission income is after tax, deduct it when? After the PAT is calculated. After the PAT is calculated. Sunk cost means cost already incurred, which cannot be recovered. You could have seen problems where some research and development expense will be given. All this is already incurred. If you have already incurred, it is irrelevant in nature. Don't try to put it in the calculation. It will unnecessarily lead to wrong decision. Overheads, be cautious about overheads. Apportion, general, corporate, everything is irrelevant. We saw this in one question when we were solving. Suddenly this item came, and if it's any specific or incremental, please consider in the calculation. Working capital, any change in working capital will have impact on my cash flow. I've already discussed increases, outflow, decreases, inflow. Decrease is going to be inflow. Reward exclusion principle says whatever cash flow you pay or receive from your owner. Who's the owner? Equity shareholder, debenture holder, preference shareholder. So if you pay any equity dividend, ignore it. If you receive any equity shares, money, ignore it. If you do buyback, ignore it. If you repay loan, ignore it. If you take a new loan, ignore it. If you pay interest, ignore it. Everything is going to be ignored in the calculation. Any cash flow between the owner and the company has to be ignored in the analysis. And last important principle is incremental. What additionally is the project generating? That is what replacement was all about. New minus old. How much is the extra cash flow getting generated? One simple rule is doing yes or no analysis. A company will incur marketing expense of 40 lakh. You will incur a marketing expense of 40 lakh if you do a project. If you do a project, incur 40 lakh. If you don't do a project, don't incur 40 lakh. It is a relevant expense. It is a relevant expense. Market survey already incurred. Market survey already incurred. If you do the project, market survey already incurred. If you don't do, already incurred. It is a sunk cost, irrelevant cost. Whether payment happened, not happened, does not matter. It is a irrelevant cost. It is a irrelevant cost. I've discussed these examples. If needed, I'll discuss. Okay, computation of NSV. I've discussed that NSV refers to the sale value adjusted for taxes. Three situation. One situation, sale value is 1 lakh, book value is lesser. If book value is lesser, you will pay tax and your NSV will go down. Your NSV will go down. Second situation, it is 0, but still you have an NSV. Still you have a NSV. Third situation, you're selling for 1 lakh, but book value is higher. Book value is higher. In this case, you will save tax. In this case, you will save tax. Saving tax will lead to benefit for you. If sale value is equal to book value, no tax. Sale value is equal to NSV. If tax is to be ignored, on capital gain, sale value is equal to NSV. Sale value 0 does not mean NSV is 0. It does not mean NSV is going to become 0. And some question gave sale value and cost of removal. What is final sale value? Sale value minus the cost of removal. Sale value minus the cost of removal. One question said sale value is equal to cost of removal. Then we said finally it is 0. It is finally 0 because if both are equal, I don't get anything. I don't get anything. Give me answer to this. Do sale value less book value. Do all that, please. 1 lakh. Sale value is 2 lakh. Book value is how much? Book value is 0. It's already fully depreciated. It's already fully depreciated for tax purpose. Capital gain 2 lakh. Tax paid 80,000. NSV is finally 1 lakh 20,000. It's already fully depreciated. We saw this adjustment in one of the question. All the MCQs has one adjustment from different questions. That's how they have been picked. If you revise with the book, it is kind of sufficient to get almost full clarity. Some practice questions if you do, it's kind of, because I have covered capital budgeting over the last 10 classes. But for us to cover this entire chapter, we are just going to take 1 hour now. 1 hour kind of revises entire stuff using the concept book. Obviously, problem solving and other things, you'll have to pick it up, marking certain questions you'll have to do. Okay, treatment of losses. In case I generate losses, three situations are possible. One, I'm an existing profit making company. If I have this, I'll set off my loss against the profit and get immediate tax saving. So tax will become an inflow in that year. Tax will become an inflow in the year of loss. Tax will become inflow in the year of loss. If you are going to carry forward, then next year carry it forward. Set off against your PBT, but don't reduce the PBT. Don't reduce the PBT. Set off means you're reducing the taxable income. You're reducing the taxable income, but PBT remains same. PBT remains same. And last situation, loss cannot be carried forward. Existing profit detail not given. You don't get any benefit. You don't get any benefit. Example, my loss of first year is how much? 80,000. It says I can set off against profit of year 2. What is the profit? Fully set off. No tax in year 2. PBT is 50. Tax in year 2 is 0. How much is still carried forward? In this 120, I'll remove 30,000. Leftover is what? Pay tax on this 90,000. And subtract this 27 from 120. Subtract this 27 from 120. Students in a hurry, subtract it from 90,000. I'm not telling you to reduce the income. I'm just telling you to reduce the tax. Don't end up reducing the income. Reduce the tax by calculating separately the taxable income. Any doubts on this? Tell me, what should I do for this? Participate quickly. Tax saving of 3 lakh because I'm an existing profit making company. I'll set off this loss against some other profit and reduce the tax for the company. Treatment of subsidy or government grant. In case you receive any subsidy or government grant, two types. One is revenue subsidy or revenue grant, and you have capital grant or capital subsidy. If you generate any capital, accounting standards depending on the conditions will allow you to adjust it with the cost of the asset, not to adjust with the cost of the asset. This is very critical because this can impact my depreciation calculation. And it is an inflow in the year when you receive it. It's an inflow in the year when you receive it, mostly year 0. One homework problem you did, you got it in the first year. You got that money in the first year. Mostly it's in year 0. Revenue grant or revenue subsidy, it will be received every year. You can assume it to be taxable above PBT. Assume it to be non-taxable below PAT. Question will not clearly specify the treatment for capital grant. We'll have to take an assumption and proceed. If the grant is adjusted with the cost of asset, it will lead to what? Lower depreciation expense. Lower depreciation expense. You'll have to be cautious about it because assumption can change the answer. What assumption to take and all I cannot tell you. Normally I say it doesn't adjust it, but still you can take whatever assumption you want to go ahead. Next, other points in computation of cash flow. Net cash inflow after depreciation. Net cash inflow after depreciation but before tax. If it's after depreciation, it becomes profit before tax because tax is yet to be subtracted. Tax is yet to be subtracted. Cash flow before tax. Cash flow before tax means depreciation is not subtracted. PBDT. dt. Payment of expenses in advance. We saw this in one question, and you're going to see this when you do a homework problem also. If you don't pay expense in advance, sorry, if you're paying expenses in advance, the cash flow will happen a year in advance. The cash flow will happen year in advance. When I do my PBT calculation, don't do any adjustment there. PBT goes by accrual method. PBT go by accrual method, deduct tax, whatever you subtracted, add it back. Whatever you subtracted, add it back, and then subtract what you actually paid. Subtract what you actually paid. We saw this in one of the question. At home, you have a homework where ignore tax is given. So you need not do the tax calculation. So no need to subtract and then do tax calculation. You can directly subtract in the year in which you are making the payment. In the year in which you are making the payment. But otherwise, if tax is there, calculation becomes a little complicated. Projects with only outflow. If you have project with only outflow, we call it as PV of outflow. We call it as PV of outflow. Outflows, write it as negative. Inflow, write it as positive. Total will be called PV of outflow because it will be a negative number. You want to put a sign, put it. You don't want to put a sign, ignore it. Tell me what should be the answer here. You did this in one of the question. What is the answer to this? Outflow in year 2. Start of year 3 is end of year 2. Start of year 3 is end of year 2. NPV versus IRR conflict. The conflict arises if NPV says project 1, IRR says project 2. If there is no life disparity. What is no life disparity? No difference in life. Go ahead with NPV approach. If there is a disparity, calculate EAB, equated annual benefit, which is NPV divided by present value annuity factor, cost of capital comma life, cost of capital comma life. Why does this happen? NPV assumes cash flows are reinvested at cost of capital. IRR assumes cash flows are reinvested at the IRR rate. This is life disparity and replacement chain. We saw one question where life disparity and replacement chain was there. Very simple concept. First project 3 years. Second project is 6 years. Calculate NPV in normal manner. Then life is different. So to make it equal, repeat the project 1 2 times. Repeat the project 1 2 times. When you repeat it 2 times, both become 6 and 6 years. Easier ways to go through EAB. Easier ways to go through EAB. Life disparity can also be solved using replacement chain method. We will have to repeat the investment so that the life of 2 projects become equal, and then go with maximum NPV. Go with maximum NPV. Equated annual cost. What is equated annual cost? Is wherever project have only outflow, we calculate EAC if life is different. If life is different. Then we learn when should I give up an existing asset. Abandonment. When should I give up an existing asset? Let me not go through the steps which are there. I had explained a logical approach. Split into 2. If you sell today, you get some money. If you use it in step 2 and step 3, that is in between flow and terminal flow, you get some money. Difference you can calculate and call it as NPV, or check both the numbers and decide whether you want to continue or discard the asset. Abandonment, I told you in a slightly different manner. The notes here are slightly different. You can follow the notes which we have dictated in the class. Abandonment, compare the two, select the one which has what? Higher inflow for me. Should I sell today or wait and sell, or use and sell it after the life? Go through this and tell me what is the NSV. NSV, opportunity outflows, NSV of old machine. Do calculation. NSV of old machine today. Okay, just give me a minute. Let's just close it. 5 more minutes, I think. So here we had to calculate NSV. What is the sale value of the machine today? 10 lakh. What will be the book value today? 20 lakh minus 3 years depreciation, which is 12 lakh 50. Losses 2 lakh 50. tax rate for capital gain is 20%. Capital gain is 20%. So consider tax at that rate. And my NSV is 1050. NSV is 1050. This is like my opportunity outflow today. Like opportunity, or if you continue with the machine, it is the opportunity outflow. Next concept is replacement, which is selling an existing asset and buying a new asset in its place. When I do my calculation, I can do separate analysis for old machine, separate analysis for new machine, or I can do a single column. How we present it is step 1 initial outflow. Initial outflow is equal to capital expenditure of new machine, incremental working capital of new machine, and salvage value NSV of old machine today. Step 2 in between flow, new separately, old separately. Very few adjustment, you do it together. If you have very few adjustment, do it together. Step 3 terminal flow of new machine, terminal flow of old machine, get the difference, consolidate and calculate NPV. Block of assets method, we saw in few questions. If you have block of assets method and if the block continues, STCG and STCL may not arise. The short term capital gain and short term capital loss may not arise. Because of this, no need to do NSV calculation. No need to do NSV calculation, and also my depreciation will be on purchase price of the new machine minus the sale value of old machine. That is my incremental. That is my incremental block value. So depreciation will be charged on existing block value minus sale value of old asset plus purchase price. And when you do find out the incremental is nothing but this. Extra is sale value of old asset and the purchase price of new machine. Purchase price of new machine. Can you give me answer to this? Will there be any capital gain? Is there any capital gain here? No capital gain. Second, so no tax paid, no tax saved and all. My incremental block values, block will increase by how much? 10 lakh and decrease by, so increases, net increases 5 lakh. On that I'll charge 10%. So incremental depreciation is 50,000. Incremental depreciation is 50,000. Then we saw a situation called capital rationing. What is capital rationing? Is demand for money is more than the supply of money. Under this situation, I have two types of projects: divisible projects and indivisible projects. What I do is I first check whether capital rationing exists, do a ranking based on profitability index, allocate the money in the order of ranking. And indivisible means what? You'll have to follow a combination approach, rank 1 plus rank 2 plus rank 3, some approaches you'll have to follow and then ultimately decide which is the right approach. Last concept is modified IRR. NPV says cash flows are reinvested at cost of capital. IRR says cash flows are reinvested at the IRR rate, at the IRR rate. To combining this, modified IRR says I'll reinvest all my cash flows at the cost of capital. Maturity cash flow is equal to year 1 cash flow into 1 plus R power balance number of years. Year 2 1 plus R balance number of years. Year 3 1 plus R balance number of years. Get one maturity number and calculate NPV on the basis of that. Calculate IRR on the basis of that. That's called modified IRR. That's technically called modified IRR. Any doubts on this? Any doubts on the concept? So what I would suggest is go through the homework. Please mark whichever question you want to solve, because so many questions will become very difficult. If you can mark those questions, it will be easy for you to complete the revision. Concept book can help you in revising the entire stuff. I have done in maybe 50 minutes. At your end, maybe you can take around 2 hours of time, because I would have explained certain things a little faster. At your time, even if you take 2 hours to revise, it is quite possible to do this day before exam. That's the objective, but mark those questions which you want to do. We'll end with this thing. Okay, let's start with the revision of chapter 4, cost of capital. we initially did a chapter on investment decision where we learned that how an organization is going to make investment. How do you evaluate an investment to be done? For the investment to be done, I need initial capital expenditure, that is money for fixed assets, also money for working capital, and that comes from our chapter 4, which is called cost of capital. As such, the term capital means long term money. It's not only equity capital. We include equity, preference, as well as debenture as part of capital. And the capital structure means composition of this long term money. And long term money, what we are trying to do here in this chapter is to find out what is the return or the reward which I need to pay to the providers of money. Equity guys need equity dividends, debt guys need interest, preference guys need preference dividends. So how are we going to service them is what this chapter is all about. In that, we initially started with cost of debt, where we learned that there can be two types of debt, and an allied category got added called as convertible debt. But two broad categories are redeemable, irredeemable. Convertible is an allied category where we saw few questions. I'll discuss as we proceed. Face value, I can take it as rupees 100 if problem is silent. You can even take 10,000. Rupees 100 is what we will prefer. Coupon rate refers to the interest rate which is payable on the bond. This is also written on the face of the instrument. Face value as well as the coupon rate is written on the face of the instrument. Issue price can be issued at par, premium, or discount. We take it as at par if the problem is silent. Redemption can be at par, premium, or discount. We again take it as par if the problem is silent. And interest is equal to face value into coupon rate. Interest after tax is equal to interest into 1 minus tax rate. Now first is cost of irredeemable debt. Cost of irredeemable debt means there is no end to this. It's a perpetuity. So our numerator is interest after tax and denominator is net proceeds. Denominator is net proceed. Interest after tax is interest into 1 minus. Net proceeds depends on whether it's an existing issue or new issue. First preference is new issue. What is new issue? Issue price minus flotation cost. That is my, what is net proceeds is the net amount I'm going to get out of issuing a bond or a debenture. So denominator I will prefer it to be issue price minus flotation cost. If data is not possible, then we go with current market price. In few question, we will take the issue price as the current market price and subtract the flotation cost, because assuming issue happens at par. So cost of irredeemable debt, interest after tax by net proceeds. Net proceeds means amount collected by the company. In case of a new issue, issue price minus flotation cost. Existing issue, net proceeds minus, net proceeds is equal to current market price. Redeemable debt, interest after tax, add average other cost, divide by average funds employed. Average other cost is equal to redeemable value minus net proceeds divided by balance life. It's divided by balance life and not the total life. Redeemable value is equal to redemption at par, premium, or discount. Net proceeds is equal to issue price minus flotation cost or current market price. A company issues 10 lakh 12% debenture of 100 each. Debenture are redeemable after the expiry of fixed period of 7 years. Company is in 35% tax bracket. Calculate the cost of debt after tax if debentures are issued at 10% discount. Whichever question we solve does not really matter how many debentures are there. We are just going to do calculation for one debenture. Redeemable, irredeemable here. Redeemable. So interest after tax is 100 into, what's the tax rate given? Sorry, interest rate is 12%, tax rate 1 minus 0.35. 100 into 12% into 1 minus 0.35 plus redeemable value is how much? Just give me. Redeemable values, nothing is given. Redeemable values 100. My net proceeds is today issue price minus flotation cost. Issue is happening at what? 90 divided by how many years? Whole divided by, give me the answer. 9.72. One peculiar thing which can happen in some question is your average other cost becoming negative. Average other cost becoming negative. Whatever. Okay, ठीक है, मतलब don't worry about the question. It should be issued at 10% premium. I wanted to maybe test that. Just change. I'll make the adjustment. Is issued at 10% premium. It is issued at 10% premium. That's the question I wanted to test here, because average other cost I wanted to show negative. I wanted to show negative. It is issued at 10% premium and not 10% discount. Next, a company issued 10,000 10% debenture of 100 each at par on 1/4/2018 to be matured on 1/4/2028. Company wants to know the cost of existing debt on when? 1/4/2023, when the market price of the debenture is 80. We want to calculate on 1/4/2023. Redeemable, irredeemable. So cost of debt is equal to interest after tax, average other cost divided by average funds employed. Interest after tax is one debenture. One debenture, we will do the calculation. 100 rupees face value into what rate? 100 into 10% into 1 minus 0.35. Tax rate is 35%. Tax rate is 35%. Redeemable value is how much? Nothing is given. 100. Net proceeds. Net proceeds is equal to current market price, because this is an existing issue and there's no data about any fresh issue being made. If there's a data on fresh issue, I can take that. 100 minus 80. Life is balance life 5 years. Whole divided by 100. Was answer 11.67%. A perpetual bond sold at 10% premium with an interest rate of 8%. What is the cost of debt if tax rate is 30%? Exactly 30 seconds for you. Get me the answer. Perpetual bond. Irredeemable debt was answer. I assume my face value to be 100. Interest is 8 into what? 1 minus, and net proceeds is 110. Issue price minus flotation cost. Issue price is 110. Issue price is 110. 8 into 1 minus 0.3 divided by 110. Any doubts on this? A company issued debentures 5 years ago for a period of 10 years. 5 years ago for a period of 10 years. Face value of the debenture is 100. Coupon is 10%. Flotation cost, historical, doesn't really matter. Current market price is 85. It will be redeemed at a premium of 5%. Tax rate 25%. Similar to the second example which I discussed. Company issued debentures 5 years ago for a period of 10 years. So balance life is now how many years? 5 years. Face value is 100. Flotation cost is 10%. Current market price is how much? 80. 5. Same formula, interest after tax, average other cost, average funds employed. What's the interest rate? 10%. 10 into 1 minus 0.25 plus redeemable values how much? 105. Net proceeds divided by 5 whole divided by 105 plus 85 by 2. 105 plus 85 by 2. 12.11%. 10-year bond with a face value of 50 is sold for 40. Interest rate on bond is 10%. Tax rate 30%. What is the cost of debt? Get me the answer. Yes. How much? Interest is 5 rupees, after tax 3.5, after tax is 3.5. Average other cost is redeemable value 50 minus net proceeds 40 divided by 10 years, divided by 10 years. 50 minus 40 divided by 10 years, so 3.5 plus 1, 4.5 divided by average of 50 and 40. Ranu and Co has issued 10% debenture of face value 100 for 10 lakh. Debenture is expected to be sold at 5% discount. It will also involve flotation cost of 10, redeemable at a premium of 10%. Calculate the cost of debenture. Get it again. 30-40 seconds for you to do this. Calculation for one debenture. Just revising the concept book will help you in revising the entire chapter 2, or that is the entire cost of capital chapter, which we did over a longer period in the regular class. So much coverage was there, and you covered this at a very fast pace. Technically, you don't even need videos for this. I'll be giving these videos to you. It will be uploaded in YouTube as well. So at any stage you want to revise, you get stuck, you will see those videos. But videos may not be of much use unless you know the base concept. Interest after tax is how much? 7 plus redeemable value. Net proceeds. Net proceeds is issue price minus flotation cost. What's the issue price? 95. Flotation cost 10. So 80. How many years? Whole divided by denominator will be 97.5. Denominator is going to be 97.5. Any doubts on this? What's the answer you get? 9 point. Any doubts on this? Clear? Okay. Now redeemable debt, some question may ask you to do IRR approach or yield to maturity approach. They may use the term IRR approach or yield to maturity approach. What we need to do is we'll have to put let's get to that. Year, cash flow, PVF, DCF, year 0, 1 to 10 years, year 10 years. You can do this from an investor point of view, from a company point of view. If you do from an investor point of view, for him outflow is first, then he gets series of inflow. If you do from company point of view, for them inflow is first and they get a series of outflow. Whichever approach you follow doesn't really matter. I will do from a company point of view. So initially it will be initially it will be plus 95 I get. Every year I pay 8 rupees after tax and on maturity I pay 110. I'll do discounting at one rate. What rate? Do your shortcut method. What is shortcut method? Interest after tax plus average other cost divided by average funds employed. Do the shortcut method, you get a number. Or below the table, they'll give 4%, 6%, 6%, 8%, some number they'll give. Start with one rate. If you get positive NPV, normally you increase the rate, here you'll have to decrease the rate. Normally you increase the rate, here you will have to decrease the rate. And if you get negative NPV, normally you reduce the rate, here you will have to increase the rate. You will have to work opposite of normal in case you write inflow on day 0. If you do from an investor point of view, minus starting and then plus plus, then normal approach, then it is a normal approach. Clear? Any doubts in this? Only one important thing you have to consider. Write the after tax cash flow of the bond, discount the cash flow at a guess rate. What is the guess rate? Two rates could be given in the question. If given in the question, take it from the question and proceed it. In case it's not given in the question, do your shortcut formula. Do the shortcut formula. If NPV is positive, reduce the discount rate. NPV is negative, increase the discount rate, which is opposite of what you normally do. Cost of debt of a deep discount bond. We saw one question where used a term called deep discount bond. What is deep discount bond is? It is not paying any interest. So don't use the earlier formula. You'll have to do only the YTM approach. Any doubts on this? Then we saw convertible debt. Convertible debt is a form of redeemable debt. It is a form of redeemable debt. So in redeemable debt, I need an item called redeemable value. Redeemable value will be higher of the two. Redeem as debt. Normal redemption value. If you're redeeming it as debt, it is the normal redemption value. Other approaches convert into what? Equity. For this, you will have to ascertain the price on that date. For ascertaining the price, what can they do? They can give the price today and say increase 5%, keep increasing. Or use the formula of KE. What is KE? K is equal to D1. G comes this side. KE minus G is equal to D1 by P0. P0 is equal to, now I don't need P0, I need P6. Then do D7. P6 if you need, do D7. And if you want P5, do D6, whichever year you want, because you want the maturity. You want the maturity and not today. You want the maturity and not the today. So cost of convertible debt is computed using the same formula as cost of redeemable debt. It can be computed using shortcut or IRR approach. IRR approach means year cash flow, PVF, DCF. Year 0 write the normal way, 1 to 10 write the normal way. At the end of year 10, higher of the two. At the end of year 10 is higher of the two. Only changes in computation of what? Redeemable value, redemption value of debt, or conversion into equity. For this I want what? Expected market price per share. I want what? Expected market price per share. Clear? Any doubts on this? Now, TT Limited issued 20,000 10% convertible debenture with a maturity period of 5 years. At maturity, debenture holders will have the option to convert the debenture into what? Equity shares in the ratio of what? 1:5. Current market price of equity share is 20 and historically the growth rate is what? 4%. What is the maturity cash flow on redemption or conversion? Redemption or conversion is a choice. If you redeem, is there any premium on redemption given in the question? Any premium on redemption or anything given in the question? No. So if you redeem, you will get 100 rupees. If you redeem, you will get 100 rupees. If you convert in the calculator, 20 plus, add 4% for 5 years, 20 plus 4 plus 4 plus 4, 5 years. Add plus 4% for 5 years. How much? Multiply into 5. So higher of the two, I can get 100 rupees or 1 to 1.67. We'll take 1 to 1.67. 15% convertible debenture of 100 each at a par with a maturity period of 6 years. On maturity, each debenture will be converted into what? 2 equity shares of the company. Risk-free rate 10%, risk premium 18%, beta 1.25. Tell me the KE with this. I've already explained all of this. Tell me KE with this. Only this much you read and tell me the cost of equity. What's the cost of equity? No, it's not 22.5. So what's the answer you said? 32. Okay. Yeah. 32.5 is right. 32.5 is right. It is 10 plus 18 into, some students may make a mistake of taking 18 as the market return and do 18 minus 10. I can't help it. I've already told multiple times, base concepts if not right, nothing can be done. So the KE formula here is RF plus beta into RM minus RF 10 1.25 into 18 you get number as. Now they are saying I am going to do this after 6 years. Conversion is after 6 years. So P6 is equal to D7. K is growth rate of dividends. Is a very good problem. This tests a lot of things. Growth rate will be computed using your formula where we did something called as point to point model. I'll discuss as we proceed. Under point to point model, you take the first dividend. What's the first dividend here? 10 per share, and the latest dividend is 12.76, and this has happened over a period of 5 years. Over a period of 5 years. So we did something called as future value is equal to present value into future value factor R comma N. Future value factor R comma N. 12.76 is equal to 10 rupee dividend into future value factor R comma 5 years. The factor is 1.276. 12.76 divided by 10. 12.76 divided by 10 is 1.276, and that is given here. 5 years and what rate? 5 years and 5%. 5 years and 5%. So the growth rate is how much? 5%. The growth rate in this case is how much? 5%. Last dividend paid by the company is how much in this example? Last dividend paid by the company. 12 point, add 5% for 7 years. Listen, I need P6 is equal to D7. D7. 12.76 plus 5 plus 5 plus 5 plus 5 do 7 times. Add 5% for 7 years. 17.9. Divide now and tell me the price. This is the expected price at the end of year 6. P6 is equal to D7 by KE minus G. Expected price at the end of year 6. What's the number? 70 point. So I'll repeat again. Here what happened is I have to calculate conversion value. What is conversion values? Number of shares into the expected price at the end of year 6. Year 6 price is equal to P6 is equal to what? D7 divided by KE minus G. KE formula RF plus beta into RM minus RF. Growth is using point to point model. I'll discuss the point to point model as we proceed. And using this I've got the price. Multiply that with 2 shares. 65.27 into 2. 130.54. This is the detailed calculation. Computing the growth rate, and from there we are moving forward to this. Any doubts on this? This is on convertible debt. Under convertible debt, only change you need to take care is you will have to take higher of the two numbers. You will have to take higher of the two numbers. Any doubts on this? Then comes the third one. The next concept called value of bond. What is value of bond? Is fair value of bond is present value of future cash flows discounted at what? Investors required rate of return. You can do a shortcut formula also. What is shortcut formula? Is interest divided by investor yield. Interest divided by investor yield. That is return which I get divided by the return which I want. Interest is the amount I get divided by whatever is the yield the investor is wanting. This is a formula for irredeemable debt or shortcut for redeemable debt. Shortcut for redeemable debt. Present value of future cash flow discounted at investors required rate of return. There can be 2-3 things. Interest rate is equal to investor expectation. Meeting expectation, issue will happen at par. Exceeding expectation, issue will happen at premium. And not meeting the expectation, issue will happen at what? Discount. The issue is going to happen at discount. Irredeemable bond can be done through perpetuity valuation. Can be done through perpetuity valuation, which is interest in rupees divided by investor expectation or yield. Get me the answer to this. 20 seconds for you to think and then give me the answer. Issue what? Company is going to pay how much? 12%. Market is wanting how much? So I'm exceeding the expectation. Cost of equity is basically a perpetuity because there is no end to it. There is no end to it. We had multiple approaches of calculating. One is called CAPM approach, which formula I said RF plus beta into RM minus RF. Realized yield approach. What is realized yield approach? Is IRR of the investor. IRR of the investor. And our usual formula is K is equal to D1 by P naught minus F plus growth rate. Plus growth rate. D1 by what? P naught minus F plus growth rate. Many question growth rate can be 0 also. One headache for us is D1 because the assumption may not be very clear or the question may not give you clarity. So in that case, assume it as D0 nearby dividend, D1 distant dividend. Get me the answer to this. In the MCQs, there will not be any clarity issue because either D0, D1 will be clear. 20 seconds for you to do this. Get me the answer. Apply the formula D1 by P naught minus F plus growth rate. Two plus 5%, 2 plus 5%, which is 2.1 divided by what? 50 plus 0.05 plus 0.05. Get the answer to this. You apply the formula first. Listen, cost of equity 14%, current price is 25, growth rate will change from 6 to 8. Assume the growth rate is 6%, apply the formula, you will get D1 as balancing figure. Copy the same D1 and change the growth rate, you will get the new price. You do it, I'll explain. First apply the formula of KE, you will get D1 as balancing figure. K is equal to D1 by P naught minus F plus growth rate. Today what is the KE? 0.14. D1 by P naught is 25. Growth is, so 0.08 into 25 is equal to D1. D1 is equal to 2 rupees. D1 is equal to 2, no? 0.08 into 25. 2 rupees. Any doubts in this? I repeat the same formula now. K is 14%. Dividend is 2. P naught is balancing figure and growth is how much now? 0.08. 0.08. What's the P naught you get now? $33.33. Any doubts on this? Clear? Can you proceed? How to compute growth rate? The first formula is ROE into retention ratio. Return on equity into retention ratio. Return on equity is equal to EAES divided by value of equity. EAES divided by value of equity. Anyway, you will see this EAES divided by value of equity when I go to ratio analysis. Retention ratio is 100% minus the payout ratio. Or point to point model, which I showed in that example. Future value is equal to present value into 1 plus R the whole power n, or into future value factor, and accordingly you do the calculation. Tell me the growth rate here. Twenty seconds for you. What's the growth rate number? 60 into directly 60% into 15.5%, you get what? 9.3%. Get me the cost of equity here. You will not have confusion on D0, D1 here. Please read and then let me know the answer. You attempt it, I'll explain. Same formula, D1 by P naught minus F plus growth rate. D1 by P naught minus F plus growth rate. What is the dividend? 4.5 will be paid immediately. I've added the word immediately. When we did in class, the immediate word was not there because in MCQ I cannot have confusion. Immediately means that is D0. Immediately means that is D0. So 4.5 plus what's the growth rate? I'll come to that in a minute. What's the price today? Growth rate is equal to ROE into retention ratio. ROE is 10%. Rate of return on retained earnings. ROE is 10% and retention ratio is 40%. Retention is 40% because 60% is getting paid out. Retention is 40%. So 40 into 10%, 4% is the growth. 0.04 and add 4% here. 4.5 plus 4%, which is the D1 dividend. How much is the D1 dividend? 4 point divide by 50. 13.36%. Any doubts on this? There's no confusion on D0 or D1 here. Cost of equity through realized yield approach. What is through realized yield approach? Is calculating the IRR of the investor. Calculating the IRR of the investor. How will you calculate IRR of the investor? Year 0 outflow of the investor. 1 dividend income, 2 dividend income, 3 dividend income, 4 dividend income, 5, 6, 7, 8 and some year he will sell it. Some year he will sell it and calculate IRR of that. That's called cost of equity through realized yield approach. CAPM model. CAPM model is useful in case a company is not paying any dividend. The formula is very simple. RF plus beta into RM minus RF. RF plus beta into RM minus RF. RF refers to risk-free return. RM refers to market return. And RM minus RF refers to risk premium of market. Risk premium of market. Some question they may use the word risk premium in the problem. Get me the answer to this. Even the options are not required. Get me the answer quickly. Not more than 20 seconds. How much? 12 into 1.4 is how much? 12 into 1.4. 16.8 plus 8. How much you said answer? 20. 24.8. Any doubts on this? Then cost of equity through earnings based approach. I have not done any question on this, but some question may say that follow earnings based approach. Nothing changes. Instead of writing D1 by P naught, you should write E1 by P naught. The formula will become E1 divided by P naught minus F plus growth rate. Ideal is D1 by P naught, but if they say follow earnings based approach, you will do what in the formula? E1 divided by P naught minus F. E1 divided by P naught minus F. We have not done in any question because this is not a good approach, but question specifically tells you because your ICA material has this. I am covering it. Cost of retained earnings is same as what? Cost of equity except in two situations. If you have flotation cost only in question, in the denominator, don't do P naught minus F, just do minus divide by P naught. That is K is equal to D1 by P naught minus F. KR is equal to D1 divided by only P naught. Only P naught. No minus F. No minus F in the formula. Only P naught. Clear? Any doubts? That's the first change. That's the first change. In case they add personal taxes, KR is equal to KE into 1 minus personal tax rate into 1 minus flotation cost percentage. 1 minus personal tax rate into what? 1 minus flotation cost percentage. Get me the answer to this. Cost of retained earnings. KR is equal to, right, KR is equal to KE into 1 minus personal tax rate into 1 minus flotation cost percentage. Personal tax rate 1 minus flotation cost percentage. One minus personal tax rate, 1 minus flotation cost percentage. One minus personal tax rate, 1 minus flotation cost percentage. What is the KE here? The rate of return of the shareholders, 10% into 1 minus 0.3 into 1 minus 0.03 into 1 minus 0.3 into 1 minus 0. Whenever you work with percentages, one number alone leave it as percentage, everything else write as decimal. Then only you'll get the right answer, otherwise you'll get confused. 6.79%. Cost of preference, no separate understanding. It is same as what? Cost of debt. It is same as cost of debt, except for interest after tax is replaced with preference dividend. Interest after tax is replaced with preference dividend. That's the only change. Other than that, nothing else changes. So preference dividend plus average other cost by average funds employed, or preference dividend divided by your net proceeds, or it can be even a convertible preference where redeemable value is equal to higher of the two. Redeem it as debt or convert into equity. It can be any category: redeemable, irredeemable, convertible. 100 if problem is silent. Coupon rate, preference dividend. Issue price, par premium or discount. Redeemable, par premium or discount. Face value into coupon rate. Preference dividend by net proceeds. Preference dividend plus average other cost by average funds employed. Average other cost, redeemable value minus net proceeds. Redeemable value plus net proceeds. Everything remains same. A company recently issued 9% preference share. The preference share sold for 40 with a par value of what? 20. Cost of issuing the stock was 5. What is the cost of company's preferred share? Redeemable, irredeemable. This is redeemable, irredeemable. No data on life becomes irredeemable. Tell me what is the amount of preference dividend per share? Amount, okay, don't tell me the percentage. Amount of preference dividend per share. 1.8. Net proceeds, issue price minus flotation cost. What is the issue price minus flotation cost? Read and let me know. It is 35. 40 minus 5. 40 minus 5. 40 is the issue price. 5 is what? Flotation cost. Get me the answer. 1.8 by 35. 5.1%. Any doubts on this? Preference dividend, interest, everything is on face value only, and even equity dividend is on face value. Any doubts on this? WACC is the cost for entire capital structure of the company. So we do two steps. First step, compute cost of individual components of capital. Now individual component can be equity, retained earnings, preference, debenture, non-convertible debenture, a term loan. I can add any category of debt. Debt I can have 100 different categories and all. If the question wants, they can keep giving it. We have seen problems where 2-3 category, mostly term loan will be there and normal debentures can be there. First you calculate the cost. Any component of capital where no extra data is there, cost is very simple. Interest rate into 1 minus tax rate or preference dividend percentage. No extra information. When I say no extra information, no issue price, no face value, no par value, nothing is given in the question. Interest into 1 minus tax rate and preference dividend percentage. Equity, they obviously will give the data. I can follow book value approach or market value approach. Book value, copy paste from the question. Market value, Take the number of shares, multiply with the market price per equity share. Take the number of preference share, multiply with market price per preference share. Take the number of debenture, multiply with market value per debenture. Lack of data, book value, market value same. Book value and market value is same. In case of market value of equity, you will have to split that between the book value of equity and book value of retained earnings ratio, because there's no separate value. There's no separate value for retained earnings. Problem silent, do either of the approach. Problem tells you an approach, follow that. Some question may ask both, do both the approaches. Compute cost of individual components of capital. Compute WACC using below format. Source cost, book value, market value, book value, market value, sum of product by sum of weights into 100. Any doubts on this? Sum of product by sum of weights into 100. I'm not discussing all this because this will, you put it in the format, you will get to the answer. In case there is any important MCQ, I'll discuss that. Just solve these MCQs at home. Okay, some extra concepts here. X interest versus cum interest value. Whichever question you are following, that is, you are doing cost of debt, cost of equity, cost of preference, you should only consider X interest value, X dividend value, and not the cum interest value or cum dividend value. If we saw a question where they are given cum dividend value, deduct the amount of dividend, get to the X dividend value and apply in the formula, whichever formula. If you want cost of preference, in the cost of preference, write the X dividend value. In case of cost of equity, write the X dividend market price, X dividend market price, and even the weights, market value weight should be what? X dividend values and X interest values and X dividend values for preference and equity and X interest value for there. Any doubts? What is the rule? Rule is very simple. X values plus dividend is equal to the cum dividend value, is equal to the cum dividend value. So from cum dividend, subtract the amount of dividend, you will get what? The X dividend value or the X interest value, whichever value you want to calculate. Any doubts on this? In market, financial security will always quote at cum interest or dividend value. Investor buying the instrument gets the instrument as well as what? Benefit of accrued interest or dividend. For computing individual, we should always use what? X interest values, X interest value. It's not only X interest value, X interest and X dividend value. Give me answer to this. Cost of preference. %8 into 25, 2 divided by what alone, tell me? 2 divided by 16. You will have to take 16 in the denominator. That is the most important part. Because if you make a mistake here, WACC, everything will go wrong. This got tested in one of the exam question by ICI. So that's why core concepts are here. Only thing which I ideally want you to do is add certain extra points wherever needed so that you get full grip of the concept and you are able to revise it together at one place. 2 divided by 16. Market value of equity and retained earnings. I've already explained this concept. Stock market does not separately value retained earnings of a company. It gives a single value for equity which combines what? Equity and reserves. For doing WACC, market value of equity should be split between what? The equity and retained earnings in the ratio of the book value. There will be few questions where KE and KR is same. Don't split, that's your wish. Because it's same. Whether you split or you don't split doesn't matter because you're going to multiply with the same percentage. If KE and KR is same, whether you split it or you don't split it does not really matter. We have seen problems where ICI did not split it. I have also not split it in the class. Doesn't really matter if KE and KR is same. Any doubts on this? I'm not discussing the MCQ. These are simple ones. Issue price versus current market price. I think the biggest headache is this. What to take as net proceeds? What to take as net proceed? My first preference is always issue price. My first preference is always issue price minus flotation cost wherever any indication is there in the question. Wherever Any indication is that. See, the only challenge with financial management is assumptions, because many places I'll say take this assumption, take this assumption. Assumptions make it very, very difficult for you to get exactly the same answer. So issue price versus flotation cost. For computing cost of individual component, we should always give preference to what? Issue price and not market price. But next headache is, what is issue price? Can be par value, can also be what? Current market price. For an equity share, it should always be current market price. For an equity share, if problem is silent, because in equity shares, what will happen? The face value will be 10 rupees, market price will be 1000 rupees. So you cannot say I've issued it at 10 rupees. Whereas in debenture and preference, the face value and market price will not have big difference. But in equity, there will be a big difference in the marketplace. So the issue price can be taken as par or current market price depending on assumption. It's your wish how you want to do it. Cost of debt or preference in case of no additional information. This I explained when I was explaining the WACC, saying that no extra data, interest into 1 minus tax rate, coupon rate. Don't try to do anything extraordinary there. Just write the numbers and then keep proceeding forward. Okay, give me the average cost of debt. Let's see how weighted average you have to do. Let's see how you are doing this. Get me answer to this. All this we have done in question. Get me answer to this. Let's see how many of you remember the weighted average part. You do this, I'll discuss it. What's the answer you got? 6 point. No simple average. I need weighted average. I need weighted average. So I need to raise how much? 4 lakh. 1 lakh 80 will come at what rate? Technically 5% after tax. Technically 5% after tax. Balance will come at what rate? 8%. So it's weighted average of 5 and 8 and not simple average. What is weighted average? 5% into 180, 8% into 220, whole divided by 4 lakh. Whole divided by 4 lakh. Issue price of debenture when market yield is given. When market yield, what is market yield? Is investor expectation. Investor expectation. So I had given you one shortcut formula to get the price. Just give me a minute. This is the formula to value the bond. You can interchange this formula and get the issue price. How will you get? Value of bond is equal to interest in rupees by investor expectation or yield. So value of bond is issue price. Issue price is equal to interest in rupees divided by investor expectation or yield. So this formula can be used to calculate what? The issue price. This is shortcut. This is shortcut. There was one exam problem where they said, get me the accurate answer. Accurate answer, year, cash flow, PVF, DCF, year 0, 1, 0 will not come, 1 to 5, 1 to 10, whatever number of years, do the discounting. Interest per debenture before tax, investor yield before tax, or do both after tax also, whichever way you want to do it. Impact of additional capital on existing cost. See, a question will say, you calculate WACC. We are done with WACC. Now they'll say, I am going to borrow extra 20 lakh rupees. When you borrow extra 20 lakh rupees, there are possibilities that dividend expectation may change, price may change for an equity share, interest rate may change for an existing debt. So whenever you borrow something extra, check, is there a change in individual components of capital, and then redo the calculation. A company may raise additional capital in the form of what? Debt. If you borrow, all other guys will start panicking. So cost may go up. If you raise equity, all guys will be happy because equity going up means risk is reducing for the company. The cost may go down also. The cost may go down also. These can change the expectation of what? Existing capital providers due to what? Increased or decreased risk. These changes will have to be reflected in the cost of existing capital and ultimately the WACC. We have done 2-3 problems on that, where we will first one WACC, second revised WACC. An extension of WACC is called WMCC, weighted marginal cost of capital. What is weighted marginal cost of capital? Cost of raising the additional money. Cost of raising the additional money. So first you'll have to write what is the additional money to be raised and then split into whatever categories you want to split. Once you get the additional money to be raised, calculate cost for various components of that and do WMCC in the same approach. WMCC, no book value, market value, one approach and we will close it. WMCC is the cost of raising additional capital. Hence for WMCC, we should consider only the new capital. WMCC will be the same under what? Book value or market value approach. This is because market value will be equal to what? Book value of capital raised. Today you issue a shares at 20 rupees. That's the market value. In book also you will record at 20. Face value plus securities premium. Face value plus securities premium. Cost of equity with P multiple. In case there is no other data in the question, I have tried all possible ways. No information about KE. One simple formula is 1 by P multiple. 1 by P multiple, but that can be used only if no other option is possible. And technically, when I explain theory, I said 100% payout has to happen. Logic is this: P multiple is equal to what? Price by earnings. 1 by P multiple is earnings by price. If earnings equal to dividend, then the formula is what? D1 by P naught plus growth. Growth is 0 because 100% payout. Growth is 0. So this inverse of P multiple will work only if there is a 100% payout. But lack of information in a question, no other option available, do 1 by P multiple. Only when nothing else is possible. Clear? Any doubts on this? We saw one question where they said my capital structure is optimum. So when I have an optimum capital structure, I will raise any additional money in that proportion only. If you are raising any additional money in that proportion, you will have a limitation on the investment you can do with the retained earnings. Beyond that, you will have to issue fresh shares. So an optimum capital structure is one which minimizes cost of capital. Company will raise any fresh capital in what? Same proportion. Hence in this situation, WMCC is equal to what? WACC. Maximum capex with retained earnings is whatever retained earnings is available divided by weight of equity. A company's optimal capital structure consists of what? 60% equity, 40% debt. Today I have how much retained earnings? This 10 lakh will be 60% of my investment. Balance 40% will come from borrowing. So 10 lakh divided by 60% is the investment I can do with what? Retained earnings. If you want to go beyond that, you can do it, but you have to issue what? Fresh equity share. Any doubts on this? Clear? With this, all concepts got revised. Again, I'm repeating. I've been telling this multiple times. Reason is I don't see students doing it. Follow the concept book, mark the questions now itself. Later on, then you tell me saying that I have so many questions in the book, I find it difficult, I cannot really help. So today itself, please mark what question you want to revise in this chapter so that it becomes easier for you to revise. This chapter took me around 12 hours in the class, 10 to 12 hours in the class. I have done revision in around 1 hour. So that is the amount of time. For me, it takes 1 hour. For you, it may take you 2 hours for you to go through this entire area. And maybe another 1.5 hours to solve extra questions and you'll be done with the chapter. Like this, if you do one revision, second revision will take lesser time. Third revision, 3 revision is what I normally tell students. If you do 3 revision, automatically things will be taken care. Clear? Okay, let's take a break now. Okay, let's start with the revision of capital structure. Now listen, in chapter 4, we learned cost of capital, where we learned capital means long-term money. the composition of that long term money is called capital structure. So in this chapter we are focusing on what should be the composition of long term money so as to have optimum results, and we have certain theories around it. So the basic definition is capital means long term money, which is equity plus long term debt and preference. Capital structure means the composition of this long term money, and optimum capital structure is the one which minimizes my cost of capital or maximizes my value of firm, or we have seen problem where we maximize EPS, maximize MPS, or maximize market value of firm depending on P multiple there, P multiple not there. This is the format for computing value of firm, starting with EBIT less interest, EBT less tax, EAT less preference dividend, EAES number of equity share, EPS, P multiple. EPS we stop many question at EPS level. If you have P multiple, you will do MPS. Again multiply with number of equity share, you will get market value of equity, add market value of preference, add market value of debt, and get market value of firm. In case question does not have P multiple, stop at this stage. If you have P multiple, go on till this. Some question with P multiple has told please stop at market price per share, because they want to maximize market price per share. The question has said maximize market price per share. If the problem tells maximize market price per share, we will stop it at that stage. Otherwise we will go until what? Market value of firm. We'll go until market value of firm. Steps for evaluation of best mix. What is best mix? Is identifying what is the mix. Step 1, finding out alternative. In that alternative, we'll understand what is the composition of debt, equity, preference, calculate interest, preference dividend, and number of equity share. In that interest, existing interest, new interest, total interest. There could be an existing borrowing which is there. Existing preference dividend, new preference dividend, total preference dividend, existing equity shares, new equity shares, and total equity shares, and put it in the format of EBIT less interest, EBT less tax, and calculate what? Either EPS or MV of firm depending on what the question wants. If problem is silent, P multiple not there, stop at EPS. P multiple there, stop at MV of firm. But some question with the P multiple has told I want to maximize market price. I want to maximize market price. Let's look at certain example. Company currently has debentures of 4 lakh, reserves of 7 lakh, and 3 lakh of equity capital. 3 lakh of equity capital. Company is planning to raise 4 lakh by debt. Company is planning to raise 4 lakh by debt. P multiple will decline by 20%. P multiple will decline by 20% if the debt ratio. What is debt ratio? We have learnt in ratio analysis. There also I told debt ratio is debt divided by debt plus equity plus preference. Debt divided by debt plus equity plus preference. Existing EPS is 4. MPS is 20. What will be the P multiple post expansion? What will be the P multiple post expansion? Can you tell me what is the existing P multiple? 5 times. And my P multiple will decline. P multiple will decline in case which scenario? Debt ratio is higher than 40%. Debt ratio is equal to what? Debt divided by debt, equity plus preference. What is the existing borrowing of the company? 4 lakhs. On top of 4, another. So this will become 8. This will become 8. Denominator is 4 plus another 4 plus 7 plus 3. 7 plus 3. What's the number you get? What is the percentage you're getting as debt ratio? It is exceeding 40%. P multiple from 5 times will go down by 20%. Will go down by 20%. So it will become what? 4 times. Any doubts on this? The funds can be borrowed at the rate of 10% up to 250, 15% over 250 and up to 10 lakh, 20% over 10 lakh. Company wants to borrow 15 lakh. What is the total interest cost if the interest is slab rate? Listen, there are 2 types of rate. One is called slab rate, second is called flat rate. Flat rate means 15 lakh directly do into 20%. 15 lakh directly do 20%. That is slab rate means income tax. What income tax says? First 3 lakh, no tax, then 3 to some, the slabs have been fixed. Can you calculate what will be the interest cost if you borrow 15 lakh? If you borrow 15 lakh, what will be the overall interest cost? 2 lakh. First 2 lakh 50 into 10%. extra 7 lakh 50 into 15%, extra 7 lakh 50 into 15%, and last 5 lakh into 20%. What's the number you said? 237 500. Same question if it's flat rate, 15 lakh into directly 20%, 15 lakh into directly 20%, which is 3 lakh rupees. Clear? Any doubts on this? ROI and ROC and EBIT linkage is very, very critical, because question will give you an EBIT, and when I do a rework scenario, I'll have to change the EBIT. Linkage was very simple. What we do is ROI is equal to EBIT by capital employed. EBIT by capital employed. No into 1 minus tax and all. Or ROC, you can give any name. Every rework problem or every problem we do, capital employed will 100% go up. Capital employed will 100% go up. If capital employed increases, EBIT is nothing but ROI into capital employed. EBIT is nothing but ROI into capital employed. So if capital employed increases or ROI increases, my EBIT will go up. If capital employed increases or ROI increases, question will say the company will continue to earn the same ROI. Same ROI does not mean same EBIT. Same ROI only means your EBIT is going to go up. Same ROI means what? EBIT will go up. How does EBIT go up because of same ROI? Because your capital employed is increasing. Capital employed is increasing. Operating profit depends on what? Return on investment and the invested capital. What is invested capital? Debt plus equity plus preference. Overall EBIT can increase due to higher ROI or higher investment. What is higher investment? Earlier investment plus new investment. Earlier investment plus new investment. In that also some question will say, I am raising money for redeeming debenture capital and expansion. If you redeem debenture capital, debentures will go down and new capital will go up. So net increase will be little lesser. Net increase will be little lesser. Earlier I had 100 lakh capital. I'm bringing extra 50 lakh. 100 plus 50 should become 150. But question says extra 50, 20 lakh you will repay. 20 lakh you will repay loans. 10 lakh you will do buyback of equity share. So this 20 and 10 will reduce my capital, and extra 50 will increase my capital. So 100 will become only 120. 100 will become only 120. Capital can increase only if you add the capital to increase fixed asset and current asset. Don't add the capital and reduce your equity capital, reserves or other item. If you do that, capital cannot increase. Capital cannot increase. Company has paid interest of 360. Okay, very simple question. Tell me answer to this. This we have to do in one question. Tell me the amount of debentures. This 3,60,000 is how many months of interest? 8 months interest. First annualize the interest. First annualize the interest. So interest will become what? 5,40,000 divided by 10%. 5,40,000 divided by 10%. Now this is very critical. In one question we had to do this, and in that I write existing interest as not 360. Existing interest I wrote there as 5,40,000. Existing interest I wrote there as 5,40,000, and I had to calculate the capital employed also. For capital employed, don't do 360 divided by 10%. You'll have to do 540 divided by 10%, which is 54 lakh rupees. Any doubts on this? Because that is critical to calculate ROI and then EBIT. ROI and then EBIT. Company earned a EBIT of 23 lakh. Existing capital include 10 lakh of debenture, 20 lakh of long-term loan, 20 lakh of reserves, and 50 lakh of equity capital. 50 lakh of equity capital. Can you tell me what is the existing capital employed? 1 crore. 23 lakh divided by 1 crore is 23%. 23 lakh divided by 1 crore is what? 23%. That is my existing ROI. My existing ROI is 23 lakh divided by 1 crore, 23%. ROI is changing by how much? So ROI will become 1 crore capital will become how much? Read carefully. 1 crore. Guys, I just now explained it. I cannot 1 crore will first have a reduction of 10 lakh. First will have a reduction of 10 lakh because it says I'm going to pay off debenture. How much they did not mention, so I assume entire debentures is paid off. Entire debentures is paid off. So 1 crore will have a reduction of what? 10 lakh. leftover is 90 lakh, add extra how much? 30 lakh, so it will become 120, and EBIT is 120 lakh into 25%, into 25%, 23 became 25, 23 became 25. Any doubts on this? EBIT is equal to what? New ROI into new capital, new ROI into new capital, how much? 30 lakhs. Tell me what is the existing ROI first. Tell me the existing ROI here. Slightly in a hidden manner, data is there. What is existing ROI? Very good problem. Existing ROI. Not 21 is wrong. 14% is right. Listen. PBT is 3 lakh. Interest is how much? 1 lakh 20. Reverse working. EBIT is divided by 12% debenture of 1 lakh 20. Debenture is 10 lakh. Equity is 20. 10 plus 20, 30 is the denominator. 10 plus 20, 30 is the denominator. What is the ROI? 14. 14 will now become what? 16. 30 lakh will become how much? 30 lakh will become 35 lakh. 30 lakh will become 35 lakh. So new ROI into new capital employed. New ROI into new capital employed. 16% into 35, how much? 5 lakh? 60,000. Any doubts on this? Now this, when we used to do in a problem, we used to do extensively discuss. Now because if you're able to link it, it is easier for you to proceed. Even those questions if you do now, you'll be able to directly get to the answer. There we would have done a lot of extra calculation. Very simple. New EBIT is equal to new ROI into new capital employed. Is the ROI changing? Is the capital employed changing? We'll have to check both. Any doubts on this? EPS versus MV of firm. What should I do? If question specifies what has to be maximized, please go ahead and maximize that. If problem is silent, P multiple not given, stop at EPS. P multiple not given, stop at EPS. P multiple given, stop at MV of firm. Some question, P multiple given, and they say stop at EPS, please stop at EPS. Don't try to get into extra calculation. There was one problem where P multiple was given and they said maximize market value per share. Maximize market value per share, which means market price per share, which means market price per share. You have to stop at MPS level. You have to stop at MPS level because the question said that. Question said that stop at MPS. I'll have to stop it at MPS. Clear? Any doubts on this? Then indifference point is the level of EBIT at which two alternatives will give what? Same EPS. In case you are solving and you're not getting an answer, one plan is dominating another plan. One plan is dominating another plan. If you solve and get an answer, above indifference point, plan 1 is better. Below indifference point, plan 2. Above and below, one plan and the other plan will be better. How do I do this? Same step. Identification of alternative, calculation of interest, preference dividend and number of equity share. And the third one is start with EBIT as X. Start with EBIT as X, get EPS in terms of X, do equating of both. When you equate them together, you will get an answer. You will get an answer for X, that is indifference point. Indifference point can only be between two alternatives. So if you have 5 alternatives in a question, indifference point between 1 and 2, 1 and 3, 1 and 4, 1 and 5, 2 and 3, you'll have to do multiple indifference point. So as such, maximum you will see 3 option. So 1 and 2, 1 and 3, 2 and 3. When you do indifference point, there can be a hidden alternative. What is hidden alternative is 100% equity. There was one question where it said, I have an alternative called 2:1 debt equity. Then what is the second alternative? Because indifference point always needs 2 alternative. The second alternative is 100% equity. The second alternative is 100% equity. 2:1 was there and the hidden alternative was what? 100% equity. Clear? Any doubts in this? Step 1, identify various alternative. Do all this. Now, financial plan has, plan 1 has interest cost of 20 lakh, number of equity shares of 10 lakh. Plan 2 has interest cost of 30 lakh, number of equity shares is 5 lakh. Tax rate is 40%. What is the indifference point between 1 and 2? I'll have to start with EBIT as X start, right? EBIT X, less interest EBT, less tax EAT, divide by number of equity shares EPS and then equate. EBIT, right, as a X and X. less interest 20 lakh, 30 lakh. EBIT X and X less interest, EBT less tax, EAT divide by number of equity shares, EPS, equate both and tell me what's the indifference point. Start doing it. Maybe around 2 minutes time. Keep doing it. Refer in case you get a doubt. Chicken should be right. X minus 20, X minus 30. EAT is, what's the tax rate? So 0.6x minus 12, 0.6x minus 18 divided by 10, 5, 1 time, 2 time. This goes the other side. 0.6x minus 12 is 1.2x minus 36. 1.2x minus 36. Net, I think the summary is 0.6x is equal to 24, x is equal to 40 lakh, x is equal to 40 lakh. Very simple format. This is what we used to do, but this is the end result. Before that, I had to do 2-3 steps. I have removed those steps, that is calculating interest, preference, dividend, number of equity shares, all that I've given directly here. Any doubts on this? Proceed. EPS of plan 1 with EBIT of 4 lakh is 10 per share. EPS of plan 1 with EBIT of 4 lakh is 10 per share. Indifference point between 1 and 2 is 4 lakh. Indifference point between 1 and 2 is 4 lakh. If indifference point is 4 lakh, plan 2 will also have the same EPS. Plan 2 will also have the same earnings per share, because indifference point is the level of EBIT at which what? Two alternatives will give same result. Two alternatives will give same result. Plan 2 has equity shares, preference capital, tax rate. How much is the rate of preference dividend? Let's write it in the same manner. Let's write PAT less preference dividend, EAES, number of equity shares, EPS, number of equity shares and EPS. My EPS has to remain same. What is 10? How many shares are there? Plan 2 has how many shares? 20,000. EAES is 2 lakhs. EAES is 2 lakhs. Preference dividend is going to be balancing figure. I go above this. Above this is EBIT slash EBT less tax. EBIT slash EBT less tax. What's the EBIT given in the question? 4 lakh. Tax is 30%, 1 lakh 20. PAT is 280. Preference dividend balancing figure 80,000. Preference dividend balancing figure is 80,000. Rate of preference dividend is 80,000 divided by 10 lakh. 8%. Any doubts on this? This is reverse working. Okay, give me answer to this. 5 financial plans. How many indifference point can be there? 5 financial plans. How many indifference points can be there? I've been discussing this many times. This 1 and 2, 1 and 3, 1 and 4 and 1 and 5. 4. Then 2 and 3, 2 and 4 and 2 and 5. So 4 plus 3. 3 and 4 and 3 and 5. 4 plus 3 plus 2. And then 4 and 5. And then 4 and 5. So totally 10 indifference points are possible. Any doubts on this? 4 between plan 1 and others. 3 between plan 2 and others, 2 between plan 3 and others, and 1 between plan 4 and others. Any doubts on this? Next we saw financial break-even point. What is financial break-even point? Financial break-even point is the level of EBIT, at which EPS is going to be 0. And formula is very simple. Financial BEP is going to be interest plus separately preference dividend divided by 1 minus tax rate. Preference dividend divided by 1 minus tax rate. In case you solve an indifference point and you don't get an answer, a plan with low BEP, dominates the plan with high BEP, because lower break even is always better. A plan with low BEP dominates the plan with what? High BEP. Also, when I do indifference point, let's assume 4 lakh is indifference point, 0 to 4 lakh, greater than 4 lakh. Above indifference point, low BEP, and above that, sorry, below that is low BEP, above that is high BP. That is, if you exceed 4 lakh, you are okay to spend more as fixed cost. When your EBIT is on the lower side, you want to have lower fixed cost. So below 4 lakh, low BP, above 4 lakh, high BP. At 4 lakh, you are indifferent. And in case you want to know what is dominating, a plan with what? High financial break even point is getting dominated with the plan having low BP. Low BP is always better. Any doubts on this? Selection of alternative. We compute indifference point by equating EPS of two alternative. In some situation, we will not get an answer for indifference point. This would mean one plan is dominating the other plan. A plan with low BP dominates the plan with what? Higher financial BP. We should ignore the plan getting dominated. While selecting the alternative. We had a question where we had plan 1, plan 2, plan 3. One domination happened. I told ignore that plan. Among the balanced plan, select a plan with low BP. When what? EBIT is below indifference point. That is, if you are below 4 lakh, low BP. When your volumes go up, you're okay to have high fixed cost and high BP. This is what we saw in marginal costing also. In marginal costing, below indifference point, low fixed cost, above indifference point, high fixed cost. Give me the answer to financial BP. Simple formula. Give me the answer to financial BP. 20 lakh plus 6 lakh divided by 1 minus tax rate. 6 lakh divided by 1 minus tax rate. Give me answer to this. Which plan should get selected? Plan 2, because I am below indifference point. I want what? Low BP. Which financial plan should be selected if EBIT is 20 lakh? Plan 1. Because above indifference point, I'm okay with what? Higher BP. Which financial plan should be selected if EBIT is 12 lakh? Either. If EBIT is 4 lakh, neither 1 nor 2, because if it's 4 lakh, plan 2 is also not achieving break even. When I'm not achieving break even, what is the point of doing that business? This is what I had done in marginal costing. I said neither machine A nor machine B. So first is you'll have to attain break even. If you're not attaining break even, that is below 8 lakh. Plan 2 doesn't attain break even. I'm not bothered about the 10 lakh part. So below 8 lakh, my logical answer is neither plan 1 nor plan 2. Give me answer to this. First tell me which plan is dominating which one. Plan 3 is dominating plan 2, which means plan 3 EPS will always be higher than EPS of plan 2. That's called domination. Domination means plan 3 EPS will always be higher than plan 2. Any doubts on this? Okay, capital structure theories, we had certain assumptions. First, we said there are only two forms of capital: debt, equity, no concept of preference. Cost of no concept of income tax. Whatever you earn, you pay it in the form of dividend. Technically, no concept of growth. I cannot have any growth because I'm paying everything in the form of dividend. So, only two forms of capital. All earnings are distributed as dividend. No concept of flotation cost. Taxes do not exist. Taxes do not exist. Later assumption was changed in Modigliani Miller with tax. Now we had an approach, we had a format. The format said EBIT less interest, EBT. Leave a line, cost of debt, cost of equity, cost of capital. Leave a line, value of debt, value of equity, value of firm. Interlinkage. Interlinkages. Value of debt is or cost of debt is equal to interest by value of debt. You can interchange the formula. You can interchange the formula. Then cost of equity. Cost of equity is equal to EBT by value of equity. EBT by value of equity. Cost of capital is equal to EBIT by value of firm, or technically your ROE formula. EBIT divided by debt plus equity plus preference. EBIT divided by debt plus equity plus preference. Net income. Net income. NOI. No change. Net income has a change. What does it say? If you keep borrowing more, cost of capital will start going down. If you keep borrowing more, cost of capital will start going down. According to this theory, cost of debt is constant, cost of equity is constant, KO, weighted average, will keep going down. Weighted average will keep going down. Cost of capital will change with what? Change in capital structure. As we change costlier equity with cheaper debt, cost of capital will decline. Cost of capital will decline. If KO goes down, value of firm will automatically go up. Value of firm will automatically go up. Specific assumption, cost of debt is constant, cost of equity is constant. Problem tells something else, please follow it. This is generally the norm. If you do any rework, you'll have to follow this when you do net income approach. Net operating income approach set NO, no change, no change. Cost of equity will go up, debt will remain constant, KO will remain constant, KO will remain constant. So any rework you are doing, KE will become balancing figure here. Cost of capital or value of firm does not change. Does not change with what? Change in capital structure. Cost of equity will increase with what? Additional debt will increase with additional debt, leading to what? Constant cost of capital, leading to constant cost of capital. Cost of equity will increase with the increase in debt and capital structure. Format I've already discussed: EBIT less interest, EBT, EAT, EAS, dividend, whatever name you want to give. Cost of debt, cost of equity. This three formula, be very clear. Be very clear. I'll keep interchanging it. Some question I'll say value of debt is interest by cost of debt. Some question I'll say interest is cost of debt into value of debt. So these are not three formulae. These are 9 formulae. These are 9 formulae. One item from P&L, one item from balance sheet, and it's a ratio. And it's a ratio. Give me answer to this. You'll have to put it in that format. If you can visualize it faster, okay. Otherwise, put it in the format. Give me the answer. 2 lakh. Okay. Your cost of debt is given as 8%. Debt is 10 lakh. This will give me interest 80,000. This will give me interest 80,000. And cost of equity 14%. Value of equity 10 lakh. This will give me EBT. EBT 1 lakh 40. 1 lakh 40 plus 80,000. 1 lakh 40 plus 80,000. 2 lakh 20 divided by 20 lakh will become cost of capital. If they ask, will become cost of capital. EBIT is 5 lakh. Again, I'll have to put it in that format. EBIT is 5 lakh. Let's tell me what is the interest figure. 2 lakh. EBT is 3 lakh. Cost of debt is 10%. Cost of equity is 15%. 3 lakh divided by 15% is value of equity. 3 lakh divided by 15%. Debt is 20, equity is 20, firm is 40. Firm is 40 and cost of capital is 5. Okay, value of firm. They only ask value of firm. Value of firm is 40 lakh. Value of firm is 40 lakh. 20 plus 20. I am least bothered about the name of the theory here. I am least bothered about the name of the theory. Again, put it in the format. Format will give you the answer. Then came approach, which is same as our normal approach without taxes. He said two companies earning same amount of EBIT should have same value. If you do not have the same value, arbitrage will happen. What is arbitrage? Is buying one company, selling one company so that the value becomes same. Value becomes same. Then he said approach with tax. Moment tax was brought in, he said, if you do not have debt, so if you have debt, you are a beneficial company. So value of levered firm is equal to value of unlevered firm plus what? Amount of debt into tax rate. Amount of debt into tax rate. Format less tax, and in our calculation everywhere into 1 minus tax. Interest into 1 minus tax, EBT into 1 minus tax, EBIT into 1 minus tax, EBIT into 1 minus tax. EBIT of unlevered company 10 lakh. EBIT of unlevered companies 10 lakh. Unlevered company means no borrowing. No borrowing. Cost of equity 10%. Can you read till this and tell me what is the value of unlevered company? Till this. What will be value of unlevered company? EBIT, interest is 0, less tax, divide by cost of equity. Put it in the format EBIT less interest, EBT less tax, 10 lakh. Is there any interest? Interest. Tax, EAT is 6 lakh divided by cost of equity is value of firm is how much? 60 lakh. This is unlevered firm. This is unlevered firm. How much are we buying back? 60 lakh into 20%, debt taken is 12 lakh. Levered firm is unlevered plus debt into tax rate. Levered firm is unlevered plus amount of debt into tax rate. 60 lakh plus amount of debt is 12 lakh into the tax rate. 12 lakh into the tax rate, which is 6480. Any doubts on this? Please put it in the format. Put this in the format. Start putting it in the format. Put it in the format. Okay, format is also not needed. You can direct, the answer is there. What's the answer you'll get? Almost the answer is there. I think format will not be needed. Is the value of unlevered company given? Value of unlevered company 1750. Value of unlevered is 1750. Levered is 1750 plus 275 plus 275 into 30%. Plus 275 into 30%. If you put it in the format, you'll get all data point. A bit all that you will get. Answer is what? 1832. This is the most important part. Net income approach, same cost of equity, different cost of capital. Net income approach is what? Same cost of equity, different cost of capital. NOI or same cost of capital, different cost of equity, and traditional both may change and have to be given in the question. Both may change and have to be, because the question will say you do analyze company A and then they'll tell you to analyze company B. Company B, depending on the approach, if you are following net income approach, for company B, you will copy paste KE. You will copy paste KE. And if you are following NOI approach or approach, you will copy paste KO. You will copy paste KO. This is without tax scenario. Without tax scenario. With the tax scenario means get one company value plus amount of debt into tax rate. All that you'll have to do. Click give the answer to this. cost of equity is constant under net income approach, and cost of capital is constant under net operating income approach. Arbitrage means making extraordinary profits without taking risk. Two types of companies are there, one with borrowing, one without borrowing. Company with borrowing is called levered company or high risk company. Company without borrowing is called unlevered company or low risk company. First, we'll have to value both the companies. Once you value, you may have a primary arbitrage or a reverse arbitrage. Primary arbitrage means levered, the company with borrowing is having higher value, and reverse arbitrage means company without borrowing. Company without borrowing is having higher value. Step 1, assume 10-20% investment in the equity of the company having higher value, and calculate the present earning. Calculate the present earning, 15%, 20%, whatever percentage you want to assume. Assume that and calculate what? Present earnings. I'll be moving from levered to unlevered. So if you are moving from, listen, levered to unlevered, this is high risk, this is low risk. If you move from levered to unlevered, high risk is going to low risk. In order to increase your risk, you have to borrow at your personal end. You'll have to borrow at your personal end. After borrowing full money, if you invest, earnings will go up. If you invest the same proportion, same earnings will be there and some surplus money will be there. Question may ask you either of the approach. So first approach is check whether arbitrage exists, calculate present earnings, sell holdings in levered company, sell holdings in levered company, borrow in line with corporate leverage, borrow and invest in the other company, invest in the other company. New earnings you can calculate. Gain is confirmed if your earnings increase. Our earnings remain same, but you have some surplus money. Earnings remain same, you have some surplus money. Other option is I can move from a unlevered to a levered. This is low risk to high risk. When I do this, I'll invest in equity as well as debt. Equity and debt of this company. Debt is little less risk, so my risk remains same. I can invest the full amount or I can invest the same proportion, so that leftover money is arbitrage gain. Leftover money is arbitrage gain. Clear? Any doubts on this? Okay, I'll end with this. Okay, I'm going to revise leverages. Uh, Again, a chapter which has very limited concept and something which can be closed even with the concept book. Even if you solve question, you don't solve question, if you're able to get answers to all MCQ, you're kind of done with the concept, because this is going to be even tougher than the normal problem. Some of the MCQs can even tougher than the are picked from those questions. The leverage concept basically says the reward which you're going to pay is going to be disproportionate to the efforts being taken. How is it going to be disproportionate? The reason for disproportionate is very simple. If I have fixed cost, my sales will go up by 20%. EBIT will go up by 40%. EBIT will go up by fixed 40% because fixed cost does not increase. Fixed cost does not increase. Or if you have fixed capital, and capital structure, which will lead to financial leverage. So this is called operating risk. The first item is called operating risk. The second item is called financial risk, and combined is called total risk. Combined is called total risk. So there are three types of risks I have: operating risk through operating leverage, financial risk through financial leverage, and total risk is through combined leverage. I have a format which starts with sales less variable cost, contribution less fixed cost, EBIT less interest, EBT less tax, EAT less preference dividend, EAES number of equity shares, EPS. My income statement many times may end at EBT if I don't have tax rate and number of shares. If I have tax rate, I may go till EAT. If I have preference dividend, I will go till EAES, and if you have number of equity share, go till EPS. Starting from sales till EBIT is operations of the company. Starting from sales till EBIT is the operations of the company. So operating leverage measures the percentage change in the first item, sales, linking the percentage item in the last item, which is EBIT. Sales and EBIT is linked through operating leverage. Sales and EBIT is linked through your operating leverage. EBIT till EPS is Financial leverage. So financial leverage links the EPS change with the EBIT change, and combined leverage is first item versus the last item. First item versus the last item. So operating leverage measures percentage change in last item EBIT with percentage change in first item sales. Financial leverage measures percentage change in last item EPS, proxy EAS, proxy EAT, proxy EBT in few question, with the first item which is EBIT for financial, and combine this, linking it together, measures the percentage change in EPS for the percentage change in sales. For the percentage change in sales. So operating leverage is contribution by EBIT, or percentage change in EBIT by percentage change in sales, are 1 by margin of safety. 1 by margin of safety. This got tested in the recent mock test paper by ICA. The concept of 1 by margin of safety. They wanted the student to first calculate break-even point, then do MOS, and then do the calculation around it. OL of 5 times would mean that if sales change by 1%, EBIT will change by 5%. Operating leverage is 7. Financial leverage is 2.2858. What change in sales will be required to bring 70% change in EBIT? First tell me which leverage links change in sales and change in EBIT. Operating leverage. First calculate operating leverage is given here. Okay, operating leverage is 7 times. Operating leverage is 7 times. If sales change by 10%, EBIT will change by 70%. If sales change by 10%, EBIT is going to change by what? 70%. Fixed cost 20 lakh, sales is 1 lakh, PV ratio 40%, operating leverage. Now and all you will know all this formula. So calculate quickly. What is operating leverage here? 30 seconds, not more than that. Contribution by EBIT, contribution is 40,000 less fixed cost EBIT, less fixed cost EBIT. So 40,000 divided by 20,000, 2 times. If operating leverage is 4, what does mean? One percent change in sales will cause a 4% change in EBIT. Will cause a 4% change in EBIT. Existing sales 24 lakh, existing EBIT is 2 lakh. Existing sales is 24 lakh, existing EBIT. OL is what? 6 times. What will be the new EBIT? What will be the new EBIT if sales increase by how much? 6 lakh. First point, which leverage links sales and EBIT? Operating leverage. Operating leverage is going to link what? Sales and EBIT. What is the percentage change in sales? 24 lakh is increasing by 6 lakh, which is a, if sales increase by 25%, OL is 6 times. OL is 6 times. EBIT will increase by what percentage? 2 lakh plus 150%. 5 lakh. 2 lakh plus 150% is 5 lakh. Any doubts on this? Any doubts on this? New product will break even if the item is sold for 14 and variable cost is 9. Item is sold for 14 and variable cost is 9. Use the formula of break even point and tell me the fixed cost first. Break even point formula and tell me the fixed cost. Formula and tell me the fixed cost. Fixed cost is equal to BP in units into contribution per unit. BP in units into contribution per unit. You get an answer of 1 lakh. You get an answer of 1 lakh. Then degree of operating leverage is 25,000 into 5. 25,000 into 5 is the contribution. Contribution minus fixed cost is EBIT. So 1 lakh 25 divided by 25. 1 lakh 25 divided by 25, you get what? 5 times. If margin of safety is 0.25, 8% increase in output, EBIT will be. First tell me output. Output means sales. Output means sales. Which leverage links sales and EBIT? Operating leverage. Margin of safety 0.25. Margin of safety 0.25. Tell me what will be the operating leverages? 4. If 8% increase in output, EBIT will increase by what? Change in sales is 8%, operating leverage is 4 times. Change in EBIT is 32%. 8% into 4. 8% into 4. 32%. Increase by 32%. 10% increase in sales. Okay, read this and give me an answer. Very good question. What's the answer? 3.5. Lot of data is irrelevant there. Sales increased by 6%. Taxable income will increase by 24%. Was not needed. I just added that. This alone is sufficient. What's the answer? 3.5 times. 3.5 times. Any doubts on this? Sales is 10 lakh. Break even sales is 6 lakh. What is the degree of operating leverage? Get this. This is what got tested in the MCQ tested by ICI. Break even sales 6 lakh. What is the operating leverage? What is MOS first? Tell me. MOS first. 4 lakh or 0.4. 4 lakh or 0.4. 1 divided by 0.4. 1 divided by 0.4. Very simple answer. 4 lakh or 0.4. 1 divided by 0.4. Any doubts on this? Financial leverage arises due to what? Fixed capital. Formula says EBIT divided by what it costs. So EBIT minus what it costs is interest. So EBIT minus interest is called EBT minus interest, sorry, minus preference dividend divided by 1 minus tax rate, or percentage change in EPS by percentage change in EBIT. 5 times would mean that if EBIT changed by 1%, EPS or EAES or EAT or EBT or taxable income. Taxable income is called EBT. Taxable income is called EBT. Give me an answer to this. Financial leverage is 3 times. EPS goes up by 15%. EPS will go up by more. EBIT will go up by lesser. EBIT will go up by lesser. So EBIT will go up by what? 5%. Okay, apply the formula. This has preference capital. So I have purposefully gave this question because many a times you may ignore preference capital. That formula you may forget it. Apply the proper formula. No hidden adjustment here. Just application of formula. EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. No hidden adjustment. It's just formula application. 1 point. What is the EBIT? Operating profit is EBIT. How much is the interest expense? So EBIT minus interest is EBT 1850. What's the preference dividend? Divided by 1 minus 0.4. Divided by 1 minus 0.4. So 20 lakh divided by I think 16 lakh. 1.25 times. Give me answer to this. This is a very simple one. $15 lakh divided by 1250. That's all. Tax rate and all is of no use. 15 lakh divided by 12 lakh 50. A bit less interest. A bit less interest. You get EBT denominator. So 15 lakh divided by 12 lakh 50,000, which is 1.2 times. This is little tricky. Apply the formula. You will get preference dividend balancing figure. Apply the formula. Preference dividend will become balancing figure. Take time. Apply the formula. I'll wait for a minute. It's a calculation. You will get PD as balancing figure. These are usual questions we do in class, so quicker and faster concept understanding can come here. What's the answer you get? Sorry, 20, 20,000. Are others getting that answer? No. What happened? Is there an error in the question? $19,998. Yeah, 20,000 is right. No, I'm getting that number. 19,998 is what I get. So should be 20,000. Solving, you will get 20,000 as the number. You can substitute 20,000 and recheck your answer if you want. 138 divided by 120 minus 20,000 divided by 0.65. You can substitute and then check the answer. Give me an answer to this. 1.15. EBIT and net profit change. EBIT and net profit. Net profit is EPS. Net profit is EPS. Percentage change in EPS 6.9. Percentage change in EBIT is 6.9 divided by 6. Same question. Can you tell me what is operating leverage? Operating leverage. What answer? No. Both are separate statement. Don't try to link them together. Sales increases 6%, net profit is 24%, combined leverage is 4 times. Combined leverage is 4 times. Financial leverage, you told me answer 1.15 times. So 4 divided by 1.15 is operating leverage. These two are separate statement. Don't try to link them together. Sales is increasing by 6%. I never said EBIT is increasing by 6%. Don't try to link both the statement together. One information is to calculate FL. Second information is to calculate CL. And this got tested in that MTP. That is why the MTP linked too many things together and then asked it. So the concept around this was asked there. Any doubts on this? Any doubts on this? Combined leverage is combining these two together. Most of the times I can do OL into FL, but for safety's sake, I'll use the formula. Formula is contribution divided by numerator of OL divided by denominator of FL. Numerator of OL divided by denominator of FL, or percentage change in EPS divided by percentage change in sales. Get the combined leverage here. Contribution divided by EBT. Combined leverage. What's the contribution figure? 12 lakhs, 20 lakh into 60%, 12 lakh. From there, fixed cost is 10 lakh, I subtract. And then interest is how much? 80,000. So leftover number is 1 lakh 20. So 12 lakh divided by 1 lakh 20, you get an answer of 10 times. Give me answer to this. What increased by 1%, then what will increase by 0.1%? Read it carefully and then give me answer. These are concept related questions. What's the answer? It is EPS and sales and not sales and EPS. It would have been sales and EPS normally. I should have said if sales increase by 1%, EPS will increase by 10%. It should have been 10% there. Instead of giving 10%, I gave 0.1. I gave 0.1. Or ideally, you should have said if sales increase by 0.1%, then EPS will increase by 1%. I should have worded the question that way. The question got worded in a different manner. It got worded in the different manner. So sales increase, EPS increase by 1%, sales will increase by 0.1%. Get me the answer to this. Combined leverage. Visualize the format of your income statement, you will get the answer. Through income statement, so very easy, but visualize the format. .2. Okay. The formula for combined leverage is what? Contribution by EBT, and contribution is EBIT plus fixed cost. EBIT plus fixed cost. If you put it in the format, automatically it will give you the answer. So EBIT plus fixed cost divided by EBT. Give me answer to this. And a very good one. Which leverage links sales and EPS? So get combined leverage. Combined leverage divided by FL is OL. Combined leverage divided by FL is OL. OL into FL is CL. OL into FL is CL. What is the combined leverage? 4, and it's 4 divided by 3, not into 3. 4 divided by 3. 4 divided by 3. Or technically it's 3 into 1.33 is equal to 4. 3 into FL into OL is equal to CL. FL into OL is equal to CL. So answer is what? 1.33 times. Give me answer to this. There's nothing in the calculator to be done. So please look at the question and then give me the answer. You understand the concept, give the answer. Which leverage links taxable income and sales? Combined leverage. Combined leverage. Taxable income is EBT. Taxable income is EBT. What's the combined leverage here? 6 times. So 10% increase in sales, 60% increase in taxable income. 60% increase in taxable income. This is our format for computing leverages. Okay, reverse working. Use the formula of FL and then give me the answer. Interest is there. Apply the formula of FL. I'll again repeat what I used to tell. If you have, listen. If you have FL formula is EBIT divided by EBT. If you have EBIT or EBT or the item in between, you will be able to calculate all the three. Your operating leverage formula is contribution divided by EBIT. If you have contribution or EBIT or the item in between. So let's try this. What's the formula for FL? EBIT divided by EBT. Ignore the preference dividend part and all. Divide by EBT. Other items will not come. What is the FL given here? 3x x minus 200. That is why if you have item in between or the numerator or the denominator, everything will get over. Tell me what's the EBIT number? 300. And quick check, 300 minus 200 is 100. 300 divided by 100 is 3 times. Get answer to this. What's the sales number? 9 lakh. Contribution 4 lakh 50 divided by EBIT is 3 lakh. So I get 1.5. Only two answers are possible. The other two are eliminated as of now. 1.5 is the contribution divided by EBIT. 4 lakh 50 divided by 3 lakh. Divided by 3 lakh. EBIT, in that, how much is the interest they are seeing? What is the interest amount? 12,000. So from 3 lakh, I subtract 12,000, I get. So what's the number? 3 lakh divided by 288 is how much? 1.042. So the first one has to be the answer. The first one has to be the answer. 1.042. Any doubts on this? It says it has long-term debt of 1 lakh 20 on which interest at 10% is payable. On which interest at 10% is payable. Some students in a hurry may take interest as 120. You will end up making a mistake. Any doubts here? What's the answer to this? Imagine the income statement or put the income statement here. You'll automatically get the answer. Imagine the income statement, automatically answer will come. Tax rate no use in case preference dividend is not there. 2,50,000 is what I see as EBIT. That is, your sales is 9 lakh, variable cost is 3 lakh, contribution is 6 lakh, fixed cost 350, EBIT 250, interest 25, EBT is 225. 250 divided by 225. Okay, one question had an item called net fund flow. Net fund flow is nothing but PAT adding back the depreciation because it's a non-cash item, and I subtract equity dividend and preference dividend because it is paid out. Give me the answer to this. Net fund flow. Formula is there in the top. Application of the formula. Your equity dividend is going to be 40% of EAES. 40% of EAES is 72,000. So 2 lakh plus 80 minus 72 minus 20. Return on investment, return on equity, we had to do in few questions. Okay, formula is already I've discussed in ratio analysis also. ROI is EBIT divided by debt plus equity plus preference, and post taxes EBIT into 1 minus tax rate. And for ROE, we take EAES by amount of equity. EAES not there, we take EBT and proceed ahead. This we have also done where? We have done it in our capital structure. We have done this in capital structure chapter. Cost of equity we used to calculate our return on equity. One more concept was that favorable versus unfavorable financial leverage. You will have a favorable financial leverage. What is favorable leverage? Is using the debt in a positive manner in case my ROI, is better than the cost of debt. ROI is better than the cost of debt. In that case, ROE will be more higher. ROE will end up going as higher than even your ROI. So if ROI is 10%, you pay only 6% to debt, guys. Equity guys will get 14-15%. Equity guys will get 14-15%. Give me answer here. Favorable financial leverage or not? Calculate ROI and then give an answer here. ROI is EBIT divided by debt plus equity. ROI is EBIT divided by debt plus equity. What's the ROI number? 75 minus 42 is 33 minus 6 27. 27 divided by 1 crore 27%. ROI is greater than interest on loan funds, and hence it has a favorable financial leverage. It has a favorable financial leverage. Clear? Any doubts on this? I'll just show you that one question which had come in the recent MTP. Not a very tricky question, but yes. If you're able to link it properly, you'll get the answer. This is the answer question. Actual sales 20 lakh, break even 15, degree of total risk is 6.5, percentage impact on EPS if EBIT is affected by 12%. Think the requirement and then we'll start discussing it. If you understand the requirement, things will become easier. Okay, which leverage links EBIT and EPS? Financial leverage. EBIT is affected by 12% means EBIT increased or decreased. I don't know. Whatever happened, EBIT has increased or decreased by 12%. 12 into FL is the EPS impact. 12 into FL is the EPS impact. What is the meaning of total risk? Combined leverage. The combined leverage is given in the question. From combined leverage, eliminate operating leverage. Eliminate operating leverage. How will you calculate operating leverage? Using margin of safety. Using margin of safety. Tell me what is the margin of safety first. Margin of safety is 5 lakh, which is 0.25. I had shown in one MCQ. That we got operating leverage. Then they linked it with some other. So they have combined 2-3 MCQs together and made it as a single MCQ here. What is the operating leverage? Tell me first. 4. Total leverage 6.5. What is the financial leverage? 1.625 into 12. 19.5 is the answer. So that's the linkage which was needed. If you are able to have concept clarity, you will be able to handle it. Otherwise, you will struggle with these questions. And it's not, I have not, it is done in the class, different places. We have done it. They have linked it together and made it as a single question. That is what MCQs can do. In at MCQ, they can end up testing lot of concepts together. Clear? Okay, with this, we'll end the session. Okay, let's start with the revision of ratio analysis. So we initially learnt that a ratio is basically expressing a relationship between two connected items. It could be connected in some logical way. Just give me. Connected in some logical way. Example, I can connect sales with a debtor. I can connect inventory with COGS, connect creditors with payable, current asset with current liability, fixed asset with sales. So some interlinkage I do. These two items which I'm interlinking can be from balance sheet, which is example current ratio, can be from P&L, which is GP margin, or can be one from P&L, one from balance sheet. Wherever possible, I'll try to take the average for the balance sheet item. Average for the balance sheet item. Many questions we have not done it because of lack of information. If one item is from P&L and other is from balance sheet, then we should take average of the balance sheet item for ratio computation. First category we saw is liquidity ratio. Current ratio is equal to current asset by current liability. Quick ratio is quick assets by current liability. In quick asset, I have to remove two items, inventory and prepaid expense. This ratio is also called as asset test ratio or liquid ratio. Asset test ratio or liquid ratio. Then we saw absolute liquidity ratio. In one exam question, this was also called as cash ratio. This was also called as cash ratio. Absolute liquidity ratio is cash and cash equivalent divided by current liability. Basic defense interval is how many days can I survive without any new sales happening, that is cash and cash equivalent plus the receivables divided by daily opex. Working capital is current asset minus current liability. Net working capital for the purpose of bank is current asset minus current liability. In current liability, I'll have to remove the short-term loans. I'll have to remove the short-term loans. Give me answer to this. Cash and cash equivalent 1000, receivables 500, inventory 300, daily expense 10. What is the basic difference interval? 30 seconds for you to do. 1000 plus 500, 1000 plus 500 divided by 10. Current asset 20 lakh. Quick asset is 4 by 5 of current asset. Quick asset is 4 by 5 of current asset. Cash and cash equivalent is half of quick asset. Half of quick asset. What is absolute liquidity ratio? What's the formula for absolute liquidity ratio? Cash and cash equivalent divided by current liability. Tell me what is cash and cash equivalent. 20 lakh is the current asset, 16 lakh is the quick asset. In that quick asset, 8 lakh is cash and cash equivalent. 8 lakh divided by 2 lakh is 4 times. Money collected from sundry debtors. Impact on current ratio. No change because cash will go up, debtors will go down. Long-term solvency, I have debt ratio, which is debt by capital employed, equity ratio, equity by capital employed, debt equity ratio, debt by equity, capital gearing ratio, debt plus preference divided by equity, debt plus preference divided by equity, debt to assets ratio or assets to debt ratio, whatever name they want to give, total debt by asset, and one ratio is called proprietary ratio, which alone you'll have to be very clear. Proprietary funds by total asset. Proprietary funds. Lot of variants of this we have seen in question. Debt can be replaced with total debt. Debt can be replaced with long-term debt. Debt can be replaced with total outside liability. Total outside liability. Preference can be added to debt or equity for these two ratio. Debt or equity for these two ratio, or you can ignore it. That's your wish. Preference will always be added to this as far as capital gearing ratio is concerned. Clear? Net worth 15 lakh, reserves and surplus to share capital 0.5. How much is share capital? Write and see. If you're not able to do it in the calculator, please write and see. 15 lakh split in the ratio of 1:0.5. 15 lakh split in the ratio of 1:0.5. So you get a number of what? 10 lakh. Similar one, related question. Share capital 10 lakh, reserves and surplus is 0.4 to shareholder fund, which means share capital is 0.6. 0.6. 10 lakh divided by 0.6 is 16 lakh 66,667. Please analyze it properly. Try to write in your notebook capital employed split like this, and then only you'll get an answer. Else you'll make a mistake. Try to split it and then get the answer. Try to put a chart and get the answer. We have done it in one question. Without putting a chart, you may not get the right answer, or you may struggle a little bit. Put a chart, chart will automatically give you the answer. Capital employed is 50 lakh, broken down into preference and debenture. How much? 15 lakh. Preference and debentures to capital employed is 15 lakh. Net worth is 35 lakh, broken down into reserves, share capital 0.251, split in the ratio of 0.25 is to 1. Equity capital is how much? 28 lakh. Any doubts on this? Capital 100 lakh, P&L 20 lakh, intangible asset 10 lakh, debt 50 lakh. How much is the debt equity ratio? debt equity ratio. Point, how 0.5? 50 divided by 100 plus 20. 50 divided by 100 plus 20. 50 divided by 120. What's the answer you get? Okay, then intangible asset, adjust it. That's the other option. We have an option of adjusting intangible asset. I've told intangible asset can be treated as fictitious. So adjust the intangible asset in the denominator. Adjust the intangible asset in the denominator. 0.45. So there, when I do a descriptive question, we have a problem which assumption to take. In MCQ, that headache is not there, because if answer is not coming, let me adjust the intangible asset in the denominator. Debt 10 lakh, equity 20 lakh. What is the debt ratio? 0.33. 10 divided by 10 plus 20. 10 divided by 10 plus 20. Total debt 40 lakh. Total asset 60 lakh. What is the proprietary ratio? What's the formula for proprietary ratio? Proprietor funds by total assets. 0.33. Proprietor fund is 20 lakh. Debt is 40 lakh. Proprietor fund is 20 lakh. 20 divided by 60. 20 divided by 60. Profitability ratio related to sales. We started with sales. Less COGS will give me COGS ratio. GP will give me GP ratio. OPEX will give me operating expense ratio. Operating profit will give me operating profit. Then I adjust these items. Pre-tax profit, net profit. Apart from that, financial expense and COGS plus OPEX. One challenge I'll face is, if I have any non-operating income, should I add it in the EBIT calculation, not add in the EBIT calculation? That's a headache which we will have if at all question has this information. Give me answer to this. What is the operating expenses? This is the homework question which you would have done. Operating expense from the following information. Do the income statement. 1 minute for you. Please do the income statement. Then only you'll get the answer. Do the income statement. Calculator will not give you the answer. Please. $30. What is the GP number? Can you subtract and tell me? Net profit is 5%, which is 3 lakh. Tax will also be 375. 750. Interest is 60,000. So EBIT is 8 lakh 10,000. Gap is 34 lakh. Gap is 34 lakh, which is the operating expense. Which is the operating expense. Net profit to capital 1 by 5. Fixed assets to capital 5 by 4. This is again done in one homework question. Fixed asset 40 lakh. NP 20%. What is the sales? Quickly use the given ratios. It's one of the homework question which you would have done. Fixed asset 40 lakh. What's the capital number? 32 lakh. Net profit to capital is 1 by 5. What's the net profit? 6 lakh 40. Divide by 20% is the sales. 32 lakh. Any doubts on this? Any doubts on this? Give me the answer to this. Now this may look very, very simple at this stage, because this is when you see the bigger question, your mind will not exactly focus there. So that is something which you'll have to handle. What's the answer to this? Here it's going to be very simple, because you know what numbers to look at. You'll exactly look at that number and then give me the answer. Increase in reserves is how much? 5 lakh. That's the net profit. But this would be a bigger part of it, would be a 20-30 line question, and in that this item will be there. You'll have to exactly focus there and then get to the answer. 5 lakh divided by 10%. Operating ratio. What is operating ratio formula? COGS plus operating expenses by sales. I gave you an example of railways. Railways is at an operating ratio of so much. So 30 plus 12, sorry, 70 plus 12, 70 plus 12. GP is 30%, COGS is 70%. So 70 plus 12%, 82% is the answer. Any doubts on this? Give me answer to this. No. Well, the option itself is not there. What's the answer? At least select one which is there in that option. It says closing reserve is what? 20% of net worth, which means closing share capital is 80% of net worth. Closing share capital is 80% of net worth. Share capital cannot change. So net worth is 1,25,000. Net worth is 1,25,000. 1 lakh divided by 80%. 1 lakh divided by 80%. 1,25,000 is the closing net worth. In that reserves is 25,000. In that reserves is 25,000. Increase in reserve is 5,000. Increase in reserves is 5,000. 5,000 divided by 10%, 50,000. 5,000 divided by 10%, 50,000. Any doubts on this? It's not anything new and all here. It's a similar adjustment, but we may not have done something like this. I have worded it slightly differently. That's all. Any doubts on this? Coverage ratio means the ability to make the payment. General formula, source of payment divided by what are we paying. If you are paying interest, EBIT by interest. Preference dividend, PAT by preference dividend. Equity dividend, EAES by equity dividend. DSCR, interest plus principal. Numerator is PAT plus depreciation, which is a non-cash item, and add back interest. And when you're doing fixed charges coverage ratio, which is there in your material, same denominator, interest plus installment. Numerator is EBIT, EBIT plus depreciation, depreciation being a non-cash item. Give me answer to this. Equity dividend coverage ratio. Sorry, 10 lakh minus 20,000, 9 lakh 80 divided by 2 lakh 50. 9 lakh 80 divided by 2 lakh 50. Any doubts on this? 3.92. Debt service coverage ratio, DSCR. Sorry, 2 point. PAT plus depreciation plus interest. Numerator is 13 lakh. Denominator is interest plus principal, 5 lakh. Denominator is interest plus principal 5 lakh. Then return on asset, ROC is EBIT by capital employed. Post tax you want to do into 1 minus tax. ROE ES by equity shareholders, and ROA is PBT divided by total assets or PAT divided by total assets, depending on whether you want to do before tax or after tax. GP 25%, total asset 50,000, net profit margin 2%. What is the return on asset? Give me the answer. GP is 25,000, sales is 2,50,000, sales is 2,50,000, net profit is 2% of 2,55,000, 5,000 on a base of 50,000, 5,000 on a base of 50,000. Return on capital employed. No tax is there. EBIT by capital employed. EBIT by capital employed. Ten lakh plus 6 lakh interest. 10 lakh plus 6 lakh interest divided by 50 plus 25 plus 15. 50 plus 25 plus 15. 16 divided by 90. Then owner's point of view, earnings per share, EAES by number of shares, dividend per share, equity dividend by number of, and payout ratios, DPS as a proportion of EPS, dividend per share as a proportion of earnings per share, and market related ratios is P multiple, earnings yield, dividend yield. So P multiple is MPS by EPS, dividend yield is dividend as a percentage of market price, earnings yield is earnings as a percentage of market price, and we have something called as MV to BV ratio, market value to book value ratio, which your material talks about. MV is market price per share, BV is book value per share, which is net worth divided by number of equity share, net worth divided by equity share. And there's one more ratio which is not very critical, Q ratio, market value of equity and liability divided by replacement cost of assets. I'll not focus much on that ratio. Give me answer to this. P ratio, how will you get here? Check. P ratio needs to be computed. You attempt it and then I'll discuss. Formula for P ratio is MPS by EPS. MPS is 48. EPS is 267 minus 27,000 divided by 80,000, which is what? 3. Depreciation doesn't impact the calculation. 48 by 3. Earnings yield. Earnings yield is EPS by MPS. EPS by MPS into 100. EPS, earnings yield. 350 minus 1 lakh is preference dividend. I get 250 divided by 25,000 shares. 10. 10 divided by 50. 10 divided by 50. Turnover ratio used to assess effectiveness of usage of resources. Formula is sales by relevant item. The relevant item can be total assets, fixed assets, current assets, working capital, capital employed, or any other item you want to. Some exception, debtors turnover ratio doesn't want us to use sales, want us to use credit sales. Debtors turnover ratio, credit sales. Inventory turnover ratio wants us to use COGS, and payables turnover ratio wants us to use purchases, credit purchases. This is what, but many a times for inventory turnover also I have used sales, and for fixed asset turnover ratio we have used COGS depending on the data given in the question. And I can convert this into days by doing 360 or 365 divided by this, or inverse the formula, relevant item by sales, relevant item by sales into 360. Tell me the average collection period. It is 60 lakh by 10 lakh 6 times 365 by 6 or 10 by 60 into 365. 10 lakh by 60 lakh into 365. Stock turnover ratio. 100 minus 40%, 60 lakhs is the COGS. Divide by 20. Divide by 20. Capital turnover ratio. Capital turnover is sales by capital employed. Sales is 200. Capital employed is equity plus reserves minus fictitious asset plus debt. Minus fictitious asset plus debt. 50 plus 40, 90 minus 20, 70 plus 10, 80. Debt are calculate this. This is what you have done in comprehensive question, but they used to be at different places. So you had to link it. Now I've given everything at one place. So in MCQ, that much only we can test. GP 54,000, GP margin 20%, sales is 270, split into cash sales 1, credit sales 4, cash sales 1 and credit sales, because credit sales is 4 times of cash sales, 4 times of cash sales. So 1 is to 4, credit sales is 216, 216 into 1 by 12 into 1 by 12, which is 18,000. Closing inventory. What's the COGS number? 3 lakh. Average stock number 75,000. Average is 75. Opening is X, closing is X plus 10,000. Closing is X plus 10,000. Average is 75,000. X will turn out to be how much? 70,000. So closing is 80,000. Creditors turnover ratio. Straightforward question. Opening 10, closing 30, cash paid to creditors 100, purchases is equal to my opening is 10, 10 plus purchases minus cash is closing, 10 plus purchases minus the cash paid, minus the cash paid is equal to closing. What's the purchase figure? Guys, tell me the purchase figure. 120. I had opening 10, I purchased 120, 130 lakh is the overall figure, cash paid. So purchases is 120 lakh, opening plus closing average is 20, 120 divided by 26 times, 120 divided by 20. Any doubts in this? Clear? Tell me the debtors outstanding. Sorry? What's the answer you get? Yeah, guys, tell me the answer you got. You first tell me now what answer you got. I have lot to worry if you get 10,800. The printed solution is an error. There is an error in the answer. That so I asked you what is the answer. You give me the answer. No, why are you worried about 2,000? So there is a wording issue. It should have been cash sales is 20% of total sales. If that has happened, then 10,800 is the answer. There is a wording issue in the question. It should have been cash sales is equal to 20%. Answer will become 10,800. Otherwise, whatever answer you said, 2,700. Get me the answer to this. Answer is 1.5. Please take certain numbers. 10 is the fixed asset. Sales is equal to 30. Current assets is another 10. So total assets is 20. 30 divided by 20 is the total asset turnover ratio. Whenever numbers are not there, assume certain numbers and proceed. Just because it says fixed asset is equal to current asset, 3 plus 3 will not become answer. You have said 3 is this, so other one is also 3. Let me add them together. It's not that way. Fixed asset is 10. Your sales figure is 3 times of that 30. So fixed asset is equal to current asset. 10 plus 10 is equal to 20. 30 divided by 20. What's the answer to this? GP 60,000, GP ratio 20%. So sales is 3 lakh. COG is 240. Velocity is 6 times. So 240 divided by 6. Answer to this. One lakh. Cash sales is 25% of credit sales. Cash sales is 25% of credit sales. Total sales is 10 lakh. Broken down into cash and credit. Broken down into cash sales and credit sales. 25 and 100. 25 and 100. So cash sales component is 2 lakh. Credit sale component is 8 lakh. 8 lakh divided by 5 times. 8 lakh divided by 5. 1 lakh 60. Just give me a minute. I've been getting continuous call. I'll have to attend this and come back. Okay, these are common adjustments which we do, that is using working capital and current ratio, computing current assets and current liability, or stock quick ratio and current ratio combination. This is to calculate your current assets, quick assets and current liability. Based on that, sales and other things will be calculated. GP margin, gross profit and stock turnover ratio, and proprietary and net working capital. Let's see the application of this. Get me answer to this. It'll take some time. Please take 1 minute and then answer this. Do your calculation. Current ratio, first apply the equation, then liquid ratio, apply the equation, and then you'll get to the answer. 1 minute time, please do it. Earlier were direct ratios, now application oriented one. 2-3 ratios combined together. Current assets is equal to 2.5 CL. Quick assets is equal to 1.5 CL. Hence CL is equal to inventory. See, the gap is CL, then the CL is equal to inventory, the gap between current asset and quick asset. So CL is 960, current asset is 960 into 2.5, which is 24 lakh. Net fixed assets 40 lakh, depreciation 20%, gross fixed assets. This is simple. Net fixed asset 40 lakh, depreciation 20%, gross fixed assets. Sorry, 50 lakhs. NFA is gross is 100 less 20 depreciation. NFA is 80. 80 is equal to 40 lakh. 80 is equal to 40 lakh. 100 equal to question mark. Fixed assets 15 lakh. Current assets 1125. Current ratio 1.5 is to 1. Capital gearing 0.5 is to 1. How much is the net worth? Lot of adjustments are there. I'll take you through. Fixed asset 15 lakh. Current asset 1125. Tell me the current liability. 7 lakh. Now, fixed assets plus current asset plus minus current liability is called capital employed. Fixed asset plus current asset minus current liability is called capital employed. Get me the answer to capital employed. 18 lakh broken down into fixed capital, net worth. Fixed capital and net worth. Capital gearing ratio is 0.5 is to 1. So capital gearing is fixed capital is 0.5. Denominator is 1. Denominator is net worth 1. Get the answer now. 0.5 is to 1. 12 lakh 50,000. That's the net worth figure. And the balance is called fixed capital. Answer to this. How much? Okay, answer is 1 crore. Now, this was one of the tricky adjustments I had told. Total current asset is 50 lakh, cash is 30%, which means debtor plus inventory is 35 lakh. Debtor is sales by 4 and inventory is zero point 0.8 sales by 8. 0.8 sales by 8. We'll have to club this together. This was one of the adjustment in one question where we had to club these ratios together. Equal to 35 lakh, X will turn out to be 1 crore. Any doubts on this? Current ratio, get me the answer to this. Total asset figure. This is simple. Fairly simple adjustment. Current asset is 30 lakh rupees and fixed asset is 40%, which means current asset is 60% of total asset. So 30 lakh divided by 60% is 50. Answer to this. This was one of the homework question. $600 into the net profit margin is PAT. PAT is how much? 60. PAT divided by net worth is 10%. RO, return on net worth, is PAT divided by 20%. So 60 lakh divided by net worth is 20%. Net worth is 300 lakh. That is split in the ratio of 6 is to 4. So reserves is 120 lakh. Was the answer to this. 30 lakh is the net worth split in the ratio of 1 is to 1.5. 30 lakh is the net worth. How 30 lakh is? 39 lakh divided by 1.3. 39 lakh divided by 1.3. Net worth is 30 lakh split in the ratio of 1 is to 1.5. You will get 18 lakh as the answer. Answer to this. There's a common adjustment. How much? Fixed assets by proprietor fund is 0.4. So FA is equal to 0.4 proprietor fund, and proprietor fund is equal to fixed assets plus net working capital, because capital employed is equal to proprietor fund here. So PF is equal to 0.4 PF plus 30 lakh, 0.6 PF is equal to 30 lakh, proprietor fund is equal to 50 lakh. Proprietor fund is 50 lakhs. Okay. This adjustment I'm not doing this question. This has that adjustment where you had to do a total of assets, total of liability, and then get to the answer. Answer to this. Sorry. Working capital is 135. Current ratio is 2.5. So what's the current asset figure you got? 2 lakh 25. Current liability 90,000. Your quick assets is going to be 1.5 of 90,000. 1.5 of 90,000, which is 1 lakh 35,000. ROE as per DuPont framework, which said ROE is EAES by PAT by amount of equity, but we'll break it into three components. One is called net profit margin, second is called asset turnover, third is called equity multiplier. So the ratio becomes net profit by sales, sales by asset, and asset by equity. Get me answer to this. What is the ROE here? Why will I give numbers so easily then? 10 into 2 into 1 by 0.5 into 1 by 0.5. It is given equity by asset. Where is it asset by equity? Into 1 divided by 0.5 was the answer to this. Five percent into 1 by 0.4 is the equity multiplier. Your asset turnover ratio is, asset is 50 lakh, sales is 200 lakh. So asset turnover is 4 times. Asset turnover is 4 times. So 5 into 4 into 1 by 0.4. 1 by 0.4. Okay, this is fine. Net income means PAT, operating income means EBIT. The term net income indicates PAT, operating income indicates EBIT. I'll end with this then. Okay, let's start with the revision of management of working capital. We'll take around 40 minutes of time. Let's start. First is working capital is basically your money required for daily operations of the company. It is technically the excess of what? Current assets, guys, participate. Excess of current assets over current liabilities of a company. If you participate, your break will be early, else this will keep getting extended. So your wish. Working capital is current assets minus current liability. What we learned in this chapter is we first learned how do I do estimation of working capital using a method called operating cycle method. We also learned estimation through line by line estimation. We also learned about a principle called liquidity versus profitability, and then there was an allied area called MPBF calculation, maximum permissible bank finance, cash discount analysis, cash budgeting, and receivables management. In that, first is operating cycle. What is operating cycle? Is time taken to convert the cash back into cash. The time taken to convert the cash back into cash. This is called as operating cycle or cash to cash cycle or cash cycle, whatever name you want to give to it. Operating cycle is equal to raw material days plus WIP days plus FG days plus debtor days minus creditor days. Now, what is raw material days? Is average raw material divided by the relevant item. What is WIP? Average WIP divided by the relevant. What is FG days? Average FG divided by the relevant item. What is debtor days? Divided by the relevant item. What is creditor days? Divided by the relevant item. For raw material, the relevant item is in your cost sheet. In your cost sheet, you write opening stock, add purchase, less closing stock. After writing closing stock, whatever item comes, which is raw material consumed. For WIP, opening WIP, less closing WIP, you get GWC, sorry, you get NWC, otherwise called as COP, otherwise called as COP. You write add opening FG, less closing FG, you get COGS. So denominator COGS. Debtors is based on credit sales, creditors is based on credit purchases. Once you get your operating cycle in days, 365 divided by the operating cycle will give you number of operating cycle, will give you number of operating, and working capital required is equal to cost of sales or annual operating cost. Cost of sales or annual operating cost into operating cycle in days divided by 360 or 365. We can follow an approach called cash cost approach, where you'll have to eliminate depreciation from the cost, where you'll have to eliminate the depreciation from the cost. Working capital requirement, annual operating cost into operating cycle in days by 365. 365 divided by number of operating cycle. Quickly give me the answer. Fairly simple MCQ. First one. Was the answer? I have a lot to worry about. If my cost is 200 lakh, how working capital can be 1000 lakh? 200 lakhs is equal to 5 cycles. We are calculating the cost for one cycle. We are calculating the cost for one cycle. And you see number of operating cycle, it's technically inverse of this. Operating cycle in days by 365. This is 365 divided by operating cycle. So total cost, I wanted to check whether you're going to take sales or cost, not division and multiplication. That part, I was confident that you will do it properly. Total cost is 200 lakh divided by 5. Divided by 5. Answer is 40 lakhs. Tell me what is the WIP days here? WIP days. Guys, please do it. Do it. What's the formula for WIP days? Average WIP divided by cost of production. I just wanted to test that. You will have to divide by cost of production. 10 lakh divided by 4 crore. Okay. I want to calculate working capital requirement under which approach? Cash cost approach. They have given raw material storage, WIP conversion, FG storage, debt collection, creditors payment. First, tell me what is the operating cycle in days. Tell me the operating cycle in days. 60 lakh. So 60 days, operating cycle is 60 days. Annual cash operating cost. Annual cash operating cost. What is the annual cash operating cost? 22 lakh 50,000 into 60 by 360. 60 divided by 360. Annual operating cost is 22 lakh 50,000 into 60 by 360. You will have to ignore the concept of depreciation. What's the amount you get? 3 lakh 75,000. Get me the FG days here. Get the FG days. I just hope you don't make a mistake here. If you make a mistake, 1 o'clock will become 2, 2 will become 3. Like that, I'll extend the time. So, 70. There's no answer. 70. Okay, sorry. 31.72. I'm not sure on the answer. Tell me how are you calculating. Just tell me that. Average of this divided by, please, using the COP, calculate COGS. I have told COP can be taken as a proxy only when COGS is not possible. So 7 lakh 50 add opening FG less closing FG will give you COGS. Will give you COGS. Denominator will be COGS. Denominator is going to be COGS. Please don't make these mistakes. Denominator is 750 plus 60 minus 70,000 plus 60 minus 70,000, 32.15. 32.15. Any doubts on this? Denominator COGS, not COP. I have told we can use COP or COGS in case data is not there. Many problem they will not give opening FG, closing FG and all. There I have no problem. Here there is very clear data opening FG and closing FG. Any doubts on this? Okay, then I go to individual estimation. Under individual estimation, I'll have to estimate various item of current asset and current liability. Every item will have a forecast basis. Raw material is forecasted on the basis of raw material consumed. WIP is forecasted based on cost of production with a degree of completion. FG is forecasted based on COGS. Debtors on credit sales. Creditors on credit purchases. Outstanding wages on total wages. Outstanding expenses on total expense. Prepaid expenses on total expense. Income tax payable on total income tax. So like that I have a basis. With the basis you do into 2 by 12, 1 by 12, 3 by 12 or 1 by 52, 2 by 52, whatever the data the question gives. You will have to estimate every item. Current assets which are forecasted individually and current liability which is forecasted individually, and that will give me working capital. On top of this working capital, I may add some reserve or contingency. And there are two types of question. I'll discuss the format in some time. There's an existing company which has a cost sheet format, and there's a new company which has a different cost sheet format. Let's do this. Tell me what will be answer to this. We have done this in one question. Cash is 175. OD is 0. OD is 0. Overdraft is not yet utilized by the company. All this we have already done. The point is, when I explained that time I have done a lot of explanation, but still we end up missing it out. That is why this revision is needed. 175 and 0. Why 175? Because I needed 250. In that OD limit is already there. OD limit is already there, which I have not used. If you had used the OD limit, cash has to be 250 and OD will be 75,000. OD will be 75,000. Use the EOQ formula and tell me the inventory. Again done in one question. Guys, do it. Please do it. It's not for you to look at the screen. It's not that I'm teaching something different here. 81. It will be square root of 2 into what's the annual demand of raw material? 50,000. 50,000 into 2 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 50 lakh 40,000 rupees or 50 lakh 40,000 units. I said 1 unit is 1 rupee there. Into what's the ordering cost? 100. Carrying cost is 15% of 1 rupee, 0.15. You get an answer of how much? 81,975. Now, cost sheet for an existing company. For an existing company, I start with raw material purchased or raw material consumed, where you have units produced into raw material cost per unit, direct wages, units produced into wage cost, overhead other than depreciation, and depreciation because not applicable. Depreciation is not applicable. Admin selling, you get your cost of sales, profit. For an existing company, opening WIP is equal to closing WIP. So GWC and NWC matches, no 5 line items. So COP is the same. No opening FG and closing FG will match. So COGS. Any doubts on this? This is an existing company data. Now, sales at 2 months credit 36 lakh, materials consumed 9 lakh, wages paid 7 lakh 20, manufacturing expense outstanding at the end of the year. Company sells its product on GP of 25%, GP of 25%, counting depreciation as part of COP. How much is the depreciation? Try it, I'll discuss it in 1 minute. This is again part of a bigger question. We have done this as part of a bigger question. If somebody has got an answer, let me know. 1 lakh? Okay, not sure. I'll just check it in a minute. Okay, I'll explain it. What is sales here? 36 lakh. GP is 25%. COGS is 75%. How much? Existing company COP also 27 lakh because opening and closing FG is same. Material is 9 lakh. Wages is 7 lakh 20. Manufacturing expenses 80,000 into 12. 80,000 into 12. It's outstanding at the end of the year. So total is 9 lakh plus 720 plus 960. How much is that? 2580. Balancing figure depreciation is 120. Depreciation is 1 lakh 20. Get me the answer to this. Total, there can't be a cash cost approach here. It has to be only total approach. Get me the answer here. This should be simple. Okay. What is my overall sales? 600 lakh broken down into cash, credit. Cash is 0.5, credit is 1. Credit is 1. So credit sales is 400 lakhs into 2 by 12. 400 lakhs into 2 by 12, which is 66 lakh, 66,667. Get me the COGS. Again, we have done it in one question. I want the COGS figure. Domestic sales, I have a GP margin of how much? 20%. So into 80 by 100. Domestic sales is 100 rupee Cost is 80, profit is 20. This price goes down to 90. Cost cannot go down. Cost cannot go down. So profit is only 10 here. Profit is only 10. So this is 10 lakh 80 into 80 by 90 by 90. The sales is on the lower side. Or you can adjust the sales from 10 lakh 80. If I adjust, it will become 12 lakh. 24 plus 12 is 36 into 80%, 28 lakh 80 you will get. Any doubts on this? This is for a new company or a new project. Only difference is I have to write opening raw material, closing raw material. Opening raw material will be 0. Closing raw material will be RM consumed into the into the inventory period by 365. RM consumed into the inventory period by 365. I'll first be writing RM consumed and then I come back to closing. And what is RM consumed is units produced into raw material cost per unit plus units in WIP into the raw material cost into the degree of completion, into the degree of completion. So this cost is units produced into cost per unit plus WIP units plus the WIP units. For the WIP units, what you need to do is WIP units you'll have to multiply with again the cost per unit and take degree of completion. Take degree of completion that you have to do for raw material, wages, overhead other than depreciation, and you will get GWC, opening WIP 0, closing WIP as a value, NWC COP, opening FG 0, closing FG as a value, COGS, admin selling, cost of sales and profit and sales. Let's see this in an example. Cost of goods sold have been derived as follows. Material used 8 lakh 40. Wages and manufacturing expense 6 lakh 25. Depreciation 235. Stock of finished goods 170. The figures given above relate only to the goods that have been finished. Only to the goods that have been finished, not to work in progress. Goods equal to 15% of the year's production. Goods equal to what? 15% of the year's production in terms of physical units are in progress on an average, requiring what? Full raw material and 40% of other expense. They have not told how many units are produced. We will take it as 100. WIP units is how much? How much is the WIP units? If 100 is production, WIP is 15. WIP is 15. So listen, my material consumed is 8 lakh 40, which is as it is. This is for 100 units plus 8,400. What is 8,400? Cost per unit into this extra part is WIP. This extra part is WIP. Then 6 lakh 25 plus 6250. What is 6250? Divide by 100 units. Divide by 100 units into 40%. Question has given 40% into 40%. Assuming I'm following a total approach, I'm considering depreciation also. 235 plus 2350 into. Can you tell me the total of this segment? This is the closing WIP. This extra add-on is the closing WIP. 8,400 into 15 into 100%. 6250 into 15 into 40%. 2350 into 15 into 40%. The extra add-on is the WIP part. Sorry. Are you getting 177? Extra part. I'm asking only the extra part. 8,400 into 15 into 100%. 6250 into 15. I don't know what is the confusion. 8,400 into 15. 6250 into 15 into 40%. 2350 into 15 into 40%. I get 177,600. 177,600. That's the extra part which I add and remove as closing WIP. Which I add and remove it as closing work in progress. Any doubts on this? Be very clear. On an new company, you will have to do the WIP adjustment. You will have to first add it. The addition is done here. Divide by 100 into 115. What is 106? 100 units plus 15 into 40%. 15 into 40%. Any doubts on this? Okay, they've asked for closing stock of year 2. Closing stock of year 2 under average cost method. So year 2 will take a lot of time for doing us the calculation. Let's start writing one by one. Tell me raw material consumed for first year. What will be raw material consumed for first year and second year? Raw material consumed for first year, second year. 15,000 into, which is 12 lakh. Second year, this has to be further broken down into opening raw material, add purchase less closing stock. I'm not doing that. Okay, I just want to calculate the FG. Next, labor and variable expenses will be how much for first year and second year? Labor and variable expense. Tell me the values. 6 lakh. Manufacturing and admin expense. 4 lakh into 24,000 into 24,000. If you have done again on production units, I'll get, I don't know what to say, 4 lakh 80. 4 lakh 80. Fixed cost has to be based on capacity. You write it in your notebook, read it every day. Fixed cost has to be, I don't know, I have told this 100 times in the class, and now also if you do into number of units produced, then I cannot help it. Even this question I was doing, that time only I said I'm getting irritated. Now again we have repeated the same mistake. One mistake you can repeat 2 times, 3 times, 20 times if you repeat, then what should I do? Next, depreciation. If you are following the total cost approach, it will come. Assuming I'm following total cost approach, it is 2 lakh 40. 2 lakh 40. This is my cost of production. Tell me the cost of production. $25 lakh 20,000. 31 lakh. No opening stock in year 1. No opening stock in year 1. Tell me the value of closing stock of year 1. Closing stock of year 1. What is the value of closing stock? Doesn't matter whether it's called FIFO method or average cost. 25 lakh 20 divided by 15,000 units. I have a closing stock of 1,000 units. I have a closing stock of 1,000 units. What's the value? 1 lakh. This becomes opening stock here. Follow average cost method and tell me the value now. Follow average cost method for year 2. Be very clear. Don't make a mistake on the average cost method. Whoever got 313, tell me what's the calculation you did. Perfect. Okay. Closing stock is 3,000. Closing stock is 3,000. There is an opening stock of 1,000. Current year production is 20,000. So put together is 21,000. And closing stock is 3,000 units. Just because you see 2018 doesn't mean you will have to write 2,000. Just looking at that one number alone will not help. But anyway, I give you benefit of doubt because this is part of a bigger question. We have done it as part of a bigger question. So when you do a bigger question, we take a lot of time to solve it. But the closing stock is 3,000 units and average cost 3120 plus 168. 3120 plus 168 divided by what? 20,000 plus 1,000 into 3,000 units. You get 469,714. Any doubts on this? Get me an answer for this. Outstanding overhead expenditure. First, tell me what will be the overhead expenditure in the cost sheet. What should you write as overhead expenditure in the cost sheet? Overhead expenses in cost sheet. How are you calculating? Just tell me that. Wrong. 1,08,000 into 60 is wrong. It's 1,04,000 into 60 plus 4,000 into 60 into 50% into 50%. I have told multiple times degree of completion for your WIP, that is in your material is 100%, wages and overheads is 50%. So 1,04,000 into what? 60 plus. This is what I explained when I started this concept. When I started a new company, I said this is a very important concept, be clear. Plus how many units? 4,000 into 60. Nothing is given in the question, 50%. What is the value of what is the value of wages? Sorry, overhead. 63 lakh into 1 by, or whatever, what is it? Into 1 by 12. Okay, there's an error here. It has to be 2 months. There's an error here. It is 2 months here. Okay, total approach versus cash cost approach. Under total approach, I consider all items, be it cash item, non-cash item, and we also consider profit. We also consider profit, and credit sales is used for estimation of debtor. Under cash cost approach, I ignore non-cash item like depreciation and cash cost of credit sales. Cash cost of credit sales. Can I deviate from this? Yes, in one question we had followed total approach, but question said use cost of sales. Use cost of sales, not cash cost, cost of sales. And in the estimation, when I did your receivables management, I've told debtors can be valued in three ways. One is your full cost, second is variable cost, third is your sales. So any of the approaches can be followed for estimation of debtor. So total approach, you'll have to follow this, but the question may tell you to deviate in that calculation. Any doubts on this? Stock of WIP is estimated on the basis of cost of production. Is estimated on the basis of cost of production and the production period. So the calculation is this, but this needs a change. What is the change? You'll have to apply this formula for every item. What is every item? Direct material cost into production period by 365 into DOC. Direct wage cost into production period by 365 into DOC. Overhead cost into production period by 365 into DOC. You can keep going on like this. We normally club everything other than material. We club everything other than material and call it as conversion cost. Call it as, and if the problem is silent, the rule is what? 100% and 50%. Rule is 100% and 50%. Production during the previous year is 1,20,000. Same level of activity, level of activity will increase by 25%. Raw material 60%, wages 10%, overhead 10%. Each unit of production is expected to be in process for 1 month. Selling price 10. How much is the closing WIP? How much is the closing WIP? Read question and tell me first what is raw material cost. What is raw material cost? Read it carefully and tell me what is the raw material cost. Direct material cost in the cost sheet. No. That's a per unit number. You tell me the overall number. Per unit is of no use to me. It is 9 lakh. Last year production is 120. This year production is going up by how much? 25%. Going up by 25%. So we have 1 lakh 50,000 units. We have 1 lakh 50,000 into 10 rupees into 60%. You said how much? 9 lakh. What is the wages cost? Wages is simple now. How much? What is the overhead cost? Have they given any degree of completion in the question? No. So my WIP is, listen, 9 lakh into production period by 12 into 100% plus others 4 lakh 50 into again 1 by 12 into 50%. For others, you'll have to take 50%. Tell me the answer. 93,750. I want work in progress under cash cost method. Please try and give me the answer. Cash cost method. Same way I did now. Whatever I did, same approach you'll have to follow. cash cost method. I lakh. Okay, the calculation is, listen, 78,000 into 117 into 2 by 52 into what percentage? 80%. And 78,000 into labor and overheads put together is how much? 129, ignoring the depreciation part, into 2 by 52 into 60%. 80% for material, 60% for others, and depreciation is to be ignored. Depreciation is to be ignored. What's the answer? You said 5 lakh 13,000. Tell me what is the degree of completion to be taken for closing WIP in this example. Read carefully and let me know. DOC for closing WIP valuation. No calculation, only the DOC is needed. Hundred percentage for materials which are added at the beginning. Which is added at the beginning? X and Y. And which is added half. Half is 50%. End is 100%. 50 plus 100 by 2, 75. So 100 for X, 100 for Y, and 75% for material Z. We have seen this in one question. If you do a second shift, WIP will not double, raw material will double, FG will double. FG and raw material is going to double. Safety margin is an extra question which I add. One way is working capital is 8 lakh, safety is 20% on base amount. Second is 20% on final working capital including the contingency. If it's on the base amount, 8 lakh into 20%. If it's on the base amount, 8 lakh into 20%. If it's on the final amount, then 8 lakh, add contingency and final amount. Final amount is 100, contingency is 20, and this is 80. So this will become 80 is equal to 8 lakh, 20 is equal to 2 lakh. 80 is equal to 8 lakh, 20 is equal to 2 lakh. Overall amount is 10 lakh. You saw this in one homework question. MPBF, we have three methods of calculating MPBF. One is called 75% of current assets minus 75% of current liability. Second method is saying I'll subtract entire current liability. 75% of current asset minus what? 100% of current liability. And then we have non-core. What is non-core? Is in the current asset, certain current asset you will have to, minimum level of current asset you will have to contribute. Extra only bank will give. So 75% of non-core current asset and deduct what? 100% of current liability. This works with the ideal current ratio of 1.33. That's how that 75% is derived. Give me answer to this. 25 lakh in that core current asset is 20%. So non-core is how much? Non-core is 20 lakh. Non-core is 20 lakh. In that 75 percentage is 15 lakh and I subtract 10 lakh. So I'll get a balance of 5 lakh. Optimum cash balance. We learned this in Baumal's model of optimum cash balance, which is similar to the EOQ. We have two types of cost here. One is called transfer cost. This is similar to the ordering cost. This is similar to the ordering cost. This is the cost I incur to convert the bank or marketable security into cash. And there's a second component called interest cost, which is like the opportunity cost. So 2 into annual demand of cash. Annual demand of cash into transaction cost per transfer divided by opportunity cost per rupee per annum. Other related formula, number of transfers like number of orders, annual demand of cash divided by the optimum cash. It's not optimum cash balance, optimum transfer. This is technically optimum transfer. Let me use the word optimum transfer here. Optimum transfer, and this is also optimum transfer. Then total transfer cost is number of transfers into transfer cost. Average cash balance is your transfer whatever is the optimum transfer divided by 2, and total interest cost is average cash balance into opportunity cost. Give me answer to this. Which one? Which explanation you want? You'll have to tell me which one. Oh, sorry, I did not even read it. Okay, okay, this answer will change then. I didn't even read it. I went with whatever you guys said. Sorry. Core current assets are 20% of non-core current asset. So my total current asset is split as core, non-core. Non-core is 100, core is 20. 25 lakh has to be split in the ratio of 20 is to 100. It has to be split in the ratio of 20 is to 100. What is the figure you get? What is the non-core figure you get? 1562 after 75% adjustment. No, give me the base figure first. 20 lakh. The 20 lakh 83,333. 20 lakh 83,333. Then do 75% of that, which is 1562 500 minus 10 lakh. The answer should be 560. Okay, answer is 562 500. Any doubts on this? The wording, I didn't read the wording. Sorry about it. 20% of non-core current asset. It said 20% of non-core, not 20% of total current assets. Get me the answer for this EOQ. Square root of 2 into what? What is the annual demand of cash? Sorry? Annual demand of cash is only 1740. Creditors are paid through net banking. Net banking is not using cash. Net banking is not using cash. All other expenses are incurred in cash which is withdrawn from bank. All other expenses are incurred in cash which is withdrawn from bank. So my cash expense is only 17 lakh 40,000. Transaction cost per transfer is 10 and opportunity cost is 0.15. Opportunity cost is 0.15. Again, I'm repeating, it's annual demand of cash. Bank balances will not come here because bank is, I need not withdraw that money. I need not withdraw that money. What's the answer you get? 15 to 32. Calculate the optimum cash balance here, or calculate the that is optimum transfer. First, calculate the optimum transfer here. Apply the formula and get me the answer. Optimum transfer. No, first get me the optimum transfer. Get me the optimum transfer. 60,000. Half of that is average. Half of that is average. Optimum divide by 2. Optimum divide by 2. Square root of 2 into 36 lakh. 2 into 36 lakh into 60 divided by 0.12. Divide by 0.12. You get an answer of how much? 60,000. Half of that is average cash. Now, cash budget is basically a tool to forecast my cash receipt and cash payment. So here what I try to do is I try to find what are the receipts which are going to come, what are the payments which are going to come. So I'll have an opening cash balance, various receipt like cash sales, collection from customers, sale of assets, miscellaneous receipt. I can have payments. After this, I may take a loan or a deposit. I can create a fixed deposit. I can liquidate a fixed deposit. I can take a loan. I can repay loan. In the event of a negative cash balance, an organization may opt to secure a new loan, may opt to take a new loan or redeem a deposit to maintain what? Financial stability. On the other side, if actual cash is exceeding the minimum threshold, it may choose to create a deposit or repay the existing loan, thereby managing its surplus cash. So if I have a minimum balance, I deposit it, and if I have lesser, I will take a loan. Clear? Any doubts on this? Sales 15,000, 20,000. Production is 12,000 and 16,000. Purchase price per kg of raw material is 50. Each unit of finished product requires 2 kg of raw material which are purchased on credit in the month before they are used in production. Before they are used in production. When I'm buying 1 month before they are used in production. Suppliers are paid 1 month after purchase. So payment month is equal to production month. Payment month is I'm buying when 1 month before production. When I'm paying after 1 month. So indirectly, if I March production is 16,000, I buy that in Feb and make the payment in March. They want to know what is the payment to supplier in March. Production of March into 50 into 2 into 50 into 2, because my payment is happening when equal to the production month, equal to the production month. 16,000 into what? 2 into 50. Typically, the company collects 20% of its sales in the month of sale, 70% in the subsequent month, 10% in the second subsequent month. All sales are credit sales. How much will be the debtors? How much will be the debtors in the month of March if the previous 3 months sales is as under? Now let's understand this. I collect 20% in the month of sale, 70% in the subsequent month, 10% in the second month after the sale. January sale, how much will you collect in January? 20%. February, 70%. March, no debtors from this. No debtors from this because everything is collected. I want to calculate the debtors of which month? March month. This February month, how much you collect? 20%. March, 70%. Leftover is 10%, which is debtor, which is 100. 100 is the debtor from Feb month sales. March month, how much you collect in March? 20%. Leftover is 80%. Leftover is 80%, which is this will be my debtor. This will be my debtor. Whatever is leftover is debtor. Clear? Any doubts on this? So debtor figure is 620. Can you read this and tell me what will be the collection in the month of March? Please do proper calculation. When I say collection, you can include the cash sales also. You can include the cash sales also. I'm not sure what is there in the solution. Include cash sales and tell me how much you will get in the month of March. Try it. What will be the collection in the month of March? You'll have to write in your notebook. Just calculator will not get you the answer. Collection from customer in the month of March. If you get this properly, the cash budget part is also revised. That is why this ensures you revise everything properly. Of the 8 lakh, how much is the cash sales? 1 lakh 60,000. Whatever credit sales is there, 15% in the month in which credit sale is done. 50% in the month in which credit sale is done. So in the month of March, 6 lakh 40 into 15%. This is from the March month. This is, see, when I do a proper problem, I write from December month, from Jan month, from Feb month. So you are able to visualize full transaction. Here, time constraint, I'm just discussing the March month. Feb month, what is the credit sales? Feb month, what is the credit sales? Of the Feb month credit sales, how much you will collect in March? 25%. January month, what is the credit sales? Of that, how much you will collect in the month of March? 58%. I don't want the answer and all. This is the calculation. So I collect 4 lakh 18 to 58, 4 lakh 18 to 25, 6 lakh 14 to 15. Cash sales is not written here. Okay, doesn't matter. The collection, I can write cash. When I do a problem, I'll have clarity on what needs to be written. This was just like an MCQ discussion. Any doubts on this? Give me answer to this. FD created. Extra I have is 45,500. I'll create the FD only till the extent of 45,000. Only to the extent of 40. Extra is 45,500. in multiples of 1000. Even if it's 45,900, you can do only 45,000. Firm had a cash balance of 20,000, which is the minimum desired level of balance. Any surplus deficit below this level is made up by temporary investment or liquidation. Temporary investment or liquidation of temporary investment or temporary borrowings or temporary borrowings. Firm has a cash balance of 10,000 on April 30. Tell me, what should I do on April 30 if I have 10,000 only? What should I do in this month? Borrow rupees 10,000. If you had any FD in the past, break that FD. Break that FD or borrow what? 10,000 rupees in the month of March. In May, repay 5,000 or create FD depending on, assuming if you take a loan here, you will have to repay the loan. If you had broken the FD, recreate the FD. So temporary borrowing or liquidation and similar way creating FD or repaying the loan. Liquidity versus profitability is a concept. Liquidity is assessed through current ratio. Profitability is assessed through ratio like ROE, ROA or return on capital employed. We have three types of company: aggressive company, high profitability, low current ratio, weak liquidity; moderate companies, moderate profitability, moderate; and conservative is low on profits, high on liquidity, strong liquidity. Fixed asset 10 crore, current liability 2.5 crore. Current asset is 20% of revenue. Revenue is 50 crore. Fixed asset 7.5 crore. Balance amount is funded with 10% debt. What is ROE if EBIT is 20% of revenue and tax rate is 40%? Quickly do a balance sheet, then only you'll be able to do this. Quickly write a balance sheet in your notebook. Quickly write. I'll complete this, then only give a break. It may go on till 10 o'clock. I'll give a break only after completing this. I cannot leave it in between. So do a balance sheet quickly. What's the fixed asset figure? Current asset, current liability, share capital, balance is debt is 10 crore. I start with an EBIT. What is the EBIT number here? 10 crore. Interest is how much now? 1 crore. EBT 9 crore. 40% tax. EAT divided by share capital. EAT divided by equity. EAT divided by the amount of equity. 72%. Any doubts on this? Calculate this. We have done this in a question. Again, you will have to do a balance sheet. Without balance sheet, you will get stuck. Do a balance sheet, you will get the answer. What's the fixed asset number? 2,000. Current asset 1,000. Current liability 0. Long term liability. Current liability is 0 because working capital is 1,000. Current liability, long term liability balancing figure 3,000. What is my profit is 2,000 into 15% plus 1,000 into 4%. 2,000 into 15% plus 1000 into 4% minus 3000 into 8%. Minus 3000 into 8%. 100. Any doubts on this? Then we went to evaluation of credit policy. If I give credit, I get a benefit which is called extra sales, extra contribution. I have a lot of disadvantages: bad debt, credit admin, cash discount, interest cost. But still, I'll do a cost benefit analysis. I start with sales, less variable cost, less fixed cost. I get gross benefit, bad debt, cash discount, credit admin, and interest cost. For interest cost, you'll have to do a separate working note. Bad debt is amount of credit sales into bad debt percent. Cash discount is amount of sales into the percentage of people opting into the cash discount percentage. Credit admin will be given in the question. And interest cost is amount of debtors into, you can have different names: opportunity cost, cost of capital, cost of long-term funds, return on investment, return on equity. So different names can be there in the question. All that will be taken as the percentage. Debtors can be valued based on sales, sales into CP by 365, full cost variable plus fixed into CP by 365, or variable cost into credit period by 365. If problem is silent, you'll have to write your assumption. We normally assume debtors based on what? Full cost of sales. Okay, I'm not going to do the question again. This is what we have done as a normal problem. Sales is 21,000. Selling price 40, variable cost 25, total cost 35, credit period allowed 1 month. Company proposes to increase the credit period. So here what happened is, I've done this earlier in the class. This is the format I had followed. Sales is 21,000 into 40 and 22,680. What is 22,680? Extra 8% sales. You will have to ensure variable cost is 25. Fixed cost is calculate for the first one, which is 21,000 into 10, and copy paste. I get my gross benefit. Debtors are valued based on sales. So debtors is equal to sales into 1 by 12, sales into 2 by 12, which is 70,000 and 151 200, and you take 25% of debtor. You take 25% of debtors. Any doubts on this? This is my interest cost. Currently, the firm has annual credit sales of 50 lakh. Accounts receivable turnover is 4 times. Variable cost is 70%. Firm is required to give a return of 25%. What is the interest cost if debtors are valued based on full cost? Get me the answer. Full cost of sales. Interest cost alone. Full cost of sales. First tell me, what is the full cost of sales? 35 lakh divided by turnover ratio. What's the debtor figure? 8 lakh into 25%. You get how much? 2 lakh 18,750. Sales manager of a company proposes to sell goods to a new customer with 10% risk of non-payment. This group would require 1.5 month credit, likely to increase sales by 1 lakh. So I do a sales of how much? 1 lakh. My cost of sales is 80,000. Gross benefit is 20,000. Bad debt risk is 10,000. Bad debt risk is 10,000. They are saying required rate of return what? After tax. Okay, find the degree of risk of non-payment. So bad debt is balancing figure. Degree of risk of non-payment. So I'll leave this as balancing figure, and I go in the reverse order. Reverse order is my PAT has to be 30% of debtor. PAT has to be what? 30% of debtor, and debtor is equal to full cost 80,000 into 1.5 by 12. So debtors is 10,000, and in the reverse order, I have PAT of 3,000, PBT of 6,000, and bad debt balancing figure. We have done this as part of a comprehensive question. Any doubts on this? Calculate the annual interest cost. We did this in yesterday's session. Annual interest cost. Take 365 days. Nothing is given in the question. 365 days. Do the calculation. It is like this: 14 lakh 55,000, which is the cost of sales, into 15% of the bill, 30 by 365 on this 24%, or in the end you write 24%, plus 1455 into what percentage of the bill? 34% into 60 by 365 into 24%. Similarly, 1455 into 30% of the bill into 90 by 365 into 24, and again 1455 20% of the bill 100 by 365 into 24%. Any doubts on this? Collection policy, there's a difference between credit policy and collection policy. What is collection policies? What is the ideal level of expense I have to incur? It is more from expense point of view rather than from income point of view. So I don't evaluate till gross benefit, I evaluate only the below part. I evaluate only the below part because the sales is going to remain same. If you spend more on collection expense, bad debt and your other cost will go down. Bad debt and other cost will go down. Average payment period, interest cost, everything will go down. So you are taking a call: should I invest higher in credit administration? Credit administration, which results in what? Reduced bad debt and interest expense. Escalation in administration cost. What is escalation? Administration cost will go up. That can counterbalance. Counterbalances whatever benefit you are getting from the other one. It can go down. It can go down. A company has a sales of 25 lakh. Average collection period is 50 days. Bad debt losses 5%. Collection expenses 25,000. Listen, today my expense is 25,000 plus bad debt is how much? 1 lakh 25,000. Bad debt is 1 lakh 25,000. Tell me, what is the interest cost today? What is the interest cost today? 360 days. 360 days. Sorry? 52 25 lakh into 50 by 360 into 15%. This is the existing situation. In revised, my collection expense goes up, bad debt goes down, interest cost goes down, and I'll select whichever is beneficial. I'll select whichever is beneficial. I just go by cost angle. And here we have not done cost of sales for data's valuation because data itself is not given. Data itself is not given. We have gone ahead and valued data on the basis of sales. Cash discount is a discount provided by seller for prompt payment. 1 by 5 net 30. 1 by 5 net 30 would mean you will get a 1% discount if you make the payment in 5 days. Otherwise, make the payment in 30 days. What is the cost of cash discount? 100 minus the amount of discount divided by 100 minus the cash discount into 365 divided by number of days of early payment into 100. A firm is considering 30-day credit to its customers. The firm wants to charge an annualized rate of how much? 24%. Wants to structure the credit in such a terms for immediate payment. So how do I do this calculation is, I want to give a return of how much? 24%. Discount, let us assume I'm going to pay X rupees. I'm going to pay X rupees. So discount is 100 minus X divided by amount which you are paying into 365 by number of days of early payment. Number of days of early payment is 30 into 100 into 100. This will give an answer for X. That is the amount you are going to pay. 100 minus amount you pay is the discount. I'm not calculating it. 100 minus the amount. 100 minus X divide by X into 365 by 30 into 100 is equal to 24. Any doubts on this? Tell me what is the annual cash discount here? Simple calculation. Amount of cash discount. $20 lakh into 40% into 1. Okay, same question. I want to know what is average collection period? What is average collection period? Average collection period. %40 into 10 plus 60% into ideal is 45, but question has said 60. Question has said 60. So 60% into 60. Calculate the cash discount percentage here. That formula which we have done. Please calculate the cash discount percentage. We have done in today's session only. Get the cash discount percentage. Amount of discount divided by amount paid into 365 by number of days of early payment. Number of days of early payment. 1.5 is the discount. Amount what you have to pay 98.5 into 365. How many days early? 40 minus 10. 30 days into 100. Get me the discount percentage here again. Benefit of availing discount, cost of not availing discount. You can give two different names to it. Three by 97 into 365 by 60. Number of days of early. Number of days of early. Eligible lending is, I have done this example. So what is eligible lending is, you will have to see what are the conditions in the question. A bank is analyzing the receivables of Jackson company in order to identify the acceptable collateral. The company's credit policy is 2 by 10 net 30. Bank will lend 80% of the accounts which are not currently overdue and where the average payment period does not exceed 10 days past the net period. My terms is 30 days. So anything above 30 is overdue. Any account is overdue. I'm removing it, and your average payment period should not exceed 40. Should not exceed 40. Anything exceeding 40. Again, 91 is exceeding, that's already removed. So these two are eligible. So eligible is 25,000 plus 11,500. On this, you will get 80%. Eligible lending is 36,500. On that, I'm getting 80%. 26 to 80. In fact, in the solution, I'm also talking about that cash discount part because I copied it from there. In the question, we had that cash discount percentage. Any doubts on this? Just give me a minute. Okay, factoring is an arrangement where what we do is we are telling that I am not able to manage the sales collection. You please take care of the collection. When he takes care of the collection, I have two types of factoring. One is with recourse, where bad debt is with the company. Without recourse, he is taking care of bad debt. I have benefits of factoring: saving in cash discount, assuming factor bears this; saving in bad debt, saving in bad debt, saving in credit admin, saving in interest. There are certain costs. I have to pay commission and interest. First is effective cost of factoring. For effective cost of factoring, I have this example. A Limited has total sales of 3.2 crore. Average collection period is 90 days. Past experience. So what I do is I first start with total sales. I start with total sales. Based on total sales into 90. Into 90, I'll get the debtor. What is the debtor figure? Total sales into 380 lakhs. On this 80 lakh, I am going to deduct my commission. I'm going to deduct my commission. What is the commission percentage? 2%. So I'll deduct 1,60,000 commission. I'll deduct reserve. Balance amount is eligible, and against that I will deduct the interest. I'll deduct the interest and give you the loan. All these numbers are for 90 days. I calculate for 360 days. 1 lakh 60 is for 90 days, 360 is 6 lakh 40, 3 lakh 16 is for 90 days. I calculate the amount and I save what? I save administration cost. I save administration cost. I also save bad debt cost. See, this question when I'm explaining, you are able to relate it faster because we just did it today. The point is you will have to keep revising. Unless you keep revising, you will not get clarity on the subject. I can teach any number of times unless you keep revising things. Even when I started with this revision, the first segment you were starting struggling. Amount of working capital itself we struggled because I did this some 2-3 days back or maybe some 5 days back. That itself we are not able to recollect. That is the challenge. Unless you revise multiple times, it will become very difficult. And in my subject, I don't expect you to revise the bigger book. This book is 92 pages. I'm just expecting you to revise 92 pages book so that you are able to take care of your exam requirement. So I reduce all this cost and I get effective cost of factoring. Effective cost is 13.79. Bank loan is 12%. What should I do? Go for bank loan because bank loan is cheaper. Bank loan is cheaper. Now, this is one thing which we saw. Average collection period. Let us assume a company is offering credit terms of 1 by 10, net 45. What is the average collection period? 80% avail discount. 20% do not avail discount. 80 into 10, 20 into 45. 80% into 10 and 20 into 45. 50% avail discount. 50% into 10. 30% pay on which day? 45th day. So plus 30% into 45 and 20% pay on 75. So plus 20% into 75. Any doubts on this? Okay, cost of loan with a compensating balance. With a compensating balance. This is a strategy adopted by the bank to increase your cost of loan. With compensating balance, a portion of the loan obtained is retained by the borrower with the bank. For instance, if you take a loan of 100, I'll have to pay interest on what? Entire 100, but 10% compensating balance is there. I get a loan of only, or I withdraw only 90. Company's bank will lend 2 lakh at 15%. 10% compensating balance will be required. 10% compensating balance will be required. 2 lakh into 15%, 30,000 is my interest. But effective loan is only 1 lakh 80. Effective loan is only 1 lakh 80. So I get 16.67. I get 16.67. And in this case, 2 lakh at 15% is 30,000. 10% compensating balance is 20,000. But already there was a compensating balance of 5,000. So extra compensating balance is only 15,000. So denominator is 1 lakh 85. Denominator is 1 lakh 85. Any doubts on this? With this, I've done this revision. Again, I've been repeating this multiple times. I just want you to keep revising the concept book. We'll take a break. Okay, let's now do the revision of last chapter, which is dividend decision. Now, as we learned, dividend is basically a reward which I pay to equity shareholders at the end of the year or during the year. During the year is called interim dividend. End of the year is called final dividend, which is getting paid out. We also learned that dividend decision is nothing but splitting the earnings of the company into two parts. One is called dividends and the second part is called retained earnings. Now, what we are doing in this chapter is we have multiple models like Walter model, Gordon's model, Graham and Dodd model, Lindner's model, Modigliani Miller model. All this is trying to find out what is the impact of dividend payment on the share price, which is technically called equity value, Now, Walter model said dividend payment depends on two major variables. One is called return on equity and second is called cost of equity. Return on equity is the return which the company earns on its retained earnings, and cost of equity is what a shareholder wants from the company. Cost of equity is otherwise called as opportunity cost of capital, rate of capitalization, rate of return which a shareholder wants, required rate of return, shareholders return, different names we had. Return on equity can also be called as ROI, ROE, IRR, return earned by the company. So all these are the different names. The relationship is if R is greater than KE, it's a growing company, I don't want to pay any dividend. Equal to KE, it's a normal company, indifferent, and lesser than KE, it is a declining scenario, and I don't want to, so declining scenario, I want to pay out 100% dividend. This is on the valuation impact. There are two parts to the value. One is called dividend, which is called D by KE, and second is called retained earnings, which is also divided by K. What is retained earnings is E minus D. E minus D. But this E minus D has a multiplier called R by K. It has a multiplier called R by KE into E minus D divided by K. So whole divided by it becomes KE, and then you have this approach. What should be the optimum payout when R is equal to 15, K is equal to 12? 0%. R is greater than KE. I'll have a 0% dividend payout. Company earns EPS of 20, ROI is 10%, cost of equity is 15%. What is the fair price of the share under Walter's model if the company has a payout ratio of 40%? I'll have to value the share with a payout ratio of what? 40%. What is the formula here? D by KE plus R by KE into E minus D divided by KE. What's the dividend we are paying? 8 KE. 15% we write it as 0.15. R by KE. R is how much? Divide by 0.15 into 12 divide by 0.15. 8 by 0.15. 106.67. P multiple 8 times, value of equity 20 lakh, PAT 2 lakh. What is optimum payout ratio? For payout ratio, I need two items. I need R and KE. What will be KE here? 1 by P multiple. 1 by P multiple, which is, and R is PAT by amount of equity. PAT by amount of equity, or EAES by amount of equity. What is the R number? 10%. What is the optimum payout ratio? 100%. ROI is 20%. Cost of capital 16%. EPS is 6 rupees. What should be the payout ratio? Dividend is a balancing figure to have a price of what? 42 as per Walter's model. Write the equation. I want a price of 42. Please apply this. 42 is equal to D by KE. D is what we are trying to calculate. R by KE into E minus D. Point 0.16 is a common denominator, which I can take it to the other side. 0.16 is a common denominator. This side we get how much? 0.16 into 42 is equal to D plus 0.2 by 0.16 is 1.25. 1.25 into 6 is 7.5, and 1.25 into D is minus 1.25 D. Net I think you will get dividend is how much? Dividend is how much? 3.12, and payout ratio will be 52%. Dividend is 3.12, payout ratio is 52%. Then we saw Gordon's model. What is Gordon's model is D1 by K minus G. Only one challenge I have is here what to take as D0 or D1, the given dividend. The given dividend can be taken as D0 or D1 depending on the information. So dividend of next year, which is dividend of current year plus the growth rate. K is cost of equity. Growth rate is ROE into retention ratio. R, we have something called as a point to point model where I take the first dividend, last dividend, and do future value is equal to present value into the future value factor. All this we learned when I did the cost of equity chapter. If a firm declared 25% dividend on a face value of 10, growth rate is 5%, rate of capitalization 12, what is the expected price? Gordon's model. They have given growth rate in the question. Wherever growth rate is given, Gordon's model will come into picture. $37.5. The calculation is 2.5 add 5%. Declared means it is D0. Add 5% divided by 0.12 minus 0.05. What's the number you get? 30, 37.5. Cost of capital of a firm is 12%. Earnings per share is 20 at the end of the year. At the end of the year, which means it's E1. It is E1. Existing payout ratio is 25%. Company is planning to increase the payout ratio to 50%. What will be the effect of this change on the market price if reinvestment rate? What is the meaning of reinvestment rate? What is the meaning of this reinvestment rate of the company is 15%? What would this mean? Reinvestment rate of the company is 15%. That's technically ROE. Whatever money I retain, I earn 15% on that. That is technically ROE. So today I am paying a dividend of 25%. So I have to find today's price and then a revised price with a change in payout ratio. Revised price. Now right, P naught, your calculation is going to be P naught is equal to D1 by KE minus G. What is the payout today? 25% on 20, it is 5.12. Growth is 75% into 15%. Growth is 75% into 15%. How much is that? What is the value you get? $666 and then I change this as payout is increasing to what? 50%, so it will become 10.12 and now my growth is 15% into retention 50. Retention is 50. 15% into 50, which is 7.5. What happens to the price? Price is declining by how much? Price is going down. It is going down by, it will decrease by 444.45. Reinvestment rate is the rate of retained earnings. On the retained earnings, how much the company is going to earn. Any doubts on this? A company share is currently priced 100. Long-term growth rate is 12%. Dividend paid is 4 per share. ROE of 16% and is changing the dividend payout ratio to 60%. How much is the new dividend per share? How much is the new dividend per share? The first problem we did today, we did this adjustment only. How much is the new dividend per share? Share is currently priced at 100. Growth rate is how much? 12. This 12 can be broken down into ROE into retention. ROE into retention. What is the ROE given in the question? Growth is ROE into retention. Tell me what is the ROE? 16%. Retention is 75%, which means payout is 25%. 25% of EPS is 4 rupees. 25% of EPS is 4 rupees. What is the EPS? 16, and on this I'm going to pay 60%. On this I'm going to pay 60%, which will become 9.6. Which will become 9.6. Any doubts on this? Get me answer to this. Market price of share. What is the dividend? 20 into the payout ratio 14. Expected means that's D1. Expected is D1. K is how much? Growth rate 3. How much? 175. Okay, there is a link between earnings per share book value per share, and ROE. This link will help you in answering one of the homework question which you are going to do. Now, what is the link is, listen, ROE formula is EAES divided by value of equity. ROE formula is EAES divided by value of equity. EAES divided by number of shares is called what? EAES divided by number of shares is EPS, and value of equity by number of shares is called BVPS, book value per share. Value of equity, which is what we saw in one of the question today, value of equity, which is share capital plus reserves, divided by number of shares is called what? Book value per share. So ROE is equal to EPS by BVPS, EPS by book value per share. This can help you in calculating earnings and dividend for the purpose of Walter and Gordon's model. Earnings and dividend. This is okay. Company has an ROE of 12%. Book value per share is 200. Book value per share is 200. EPS is 200 into 12%. EPS is 200 into 12%, which is 24 rupees. Then we saw Gordon's model, step up growth. What is step up growth is? Growth changes. A company may grow at different rates before the stabilization happens. I cannot use my Gordon formula unless you tell me a single growth rate. So what I do, dividends till the first year of stabilization, MPS at the beginning of the stabilization phase, and discount all of this using year cash flow, PVF and DCF, and put a total of the DCF. That becomes the fair price of the share. That will become the fair price of the share. I just put the total of the DCF. A company reported EPS of 15 in last year. EPS will grow at 15% for 2 years and then stabilize at 10% growth. Payout ratio is 40%. What is the fair price at the end of year 2 if cost of equity is 15%? I'll give the formula, you do your calculation. I want P2 divide equal to D3 by KE minus G. Read carefully and then get me the answer. P2 is equal to D3 by KE minus G. Today the EPS is 15 rupees. Add 15% for the first year. Tell me what's the number? 15 plus 15%. Add another 15%. Add 10%. In that payout is 40%. In that payout is 40%. Payout is what? 40% of that number. Payout is 40% of the third year earning. Third year earning. What is the pay? What is the dividend you got after 40%? 8.7. Okay, 72 or 738 divided by 0.15 minus 0.10. 0.15 minus 0.10. 174.56. Okay, cum dividend price and ex dividend price. This concept is very simple. That share will mostly quote at cum dividend price in the market whenever dividends are declared. This share price has to fall by the amount of dividend once the share becomes ex dividend. This concept is very critical when you do your cost of equity calculation in the cost of capital chapter, where we had one question on KP, cost of preference, also cum dividend. You have to remove the dividend component and then calculate the values. So every formula can only use the ex dividend value. No formula can use the cum dividend value. We did this today. Mr. H is holding 1 lakh shares and currently the share of HM Limited is trading at rupees 50 per share. Mr. A have a policy to reinvest the amount of any dividend received. So 1 lakh shares into 10 rupees is my dividend. 1 lakh shares into 10 rupees is my dividend. That is 10 lakh. 50 minus 10. 50 minus 10 is the denominator, which is 40 rupees. 50 minus 10 is the denominator, 40 rupees. I'll be getting 25,000 shares. Graham and Dodd model, where we have dividend earning by 3. Earning by 3. It's not retain earnings by 3. It's earning by 3 into a multiplier. Give me the answer quickly. earnings is 30 rupees, dividend is 0.6 earning, dividend is 0.6 of the earnings, and after you get the answer you can substitute and check 30 into 60%, 18 rupees is the dividend, 18 plus 30 by 3, 28 into 2, 56. Lindner's model said how much should the company dividend. Its basically thing is, in case you get a bumper year, you should not have a significant increase in dividend, so that later on dividends have to decline. First you find out your last year dividend per share, then find out the target dividend per share in the current year based on some earnings which is there. Find out the tentative increase. Actual increase is equal to tentative increase into an adjustment factor, and then the final answer is whatever last dividend plus the actual increase. Get me the answer to this. This is a new example, so calculate. Intuition said 10.8. You saw the answer? Okay. Not sure. Dividend of last year is 10 rupees. Dividend of current year should ideally be 15 into 80%, 12 rupees. Tentative increase is 2 rupees. Actual increase is 2 into 40%, 0.8. And the final dividend is 10.8. Next is approach. Now, approach basically said it's a dividend irrelevance model, which said the value of the firm is not going to be impacted whether you pay dividends or you don't pay dividends. Price at the end of the year is opening price into 1 plus the K. That should be the final price. In case you are paying any dividend, I'll subtract it. Then I calculate what is the retained earnings of the company. Investment minus the retained earnings is the fresh issue of equity shares, divide by number of shares, and finally closing shares into closing price, which will match in both the situation. Do the calculation to me. Do the calculation. In intuition to do the calculation. To 8. My profits is 3 lakh. In that dividend is going to be 1 lakh rupee. Dividend is going to be 1 lakh rupee. So leftover is 2 lakh. Investment is 5 lakh. So I need 3 lakhs divided by 3 lakh divided by current share price is 100, 110, 106. Price of share by end of year. 100 plus 12%, it should become 112. Deduct 6 rupees dividend. Deduct 6 rupees dividend. Impact of buyback on book value per share. My existing net worth will go down by the amount of buyback done, and denominator number of shares will go down, and the book value per share will get impacted. Get the answer to this. New numbers. You do the calculation. Okay. 10,000 into the existing net worth is 10,000 into 200. What's the existing net worth? 10,000 into 200 is 20 lakhs minus 2,000 into 250 is 5 lakhs divided by 10,000 minus 2,000. Answer is 187.5. Clear? ठीक है. I'm done with everything. So prepare well. I may meet you again for your revision classes if we keep. I'm not giving you full assurance on that. But if I keep revision, I'll meet you that time. Else, whenever you come to academy or for your CA final classes, because I know you will get into CA final. Okay, done. Thank you.